And I was talking to our Martin Schenker today about this. I mean, China is a huge deal. The Secretary of Defense speaking in Singapore moments ago. John, I get that China's a huge deal. I get that the Fed meeting tomorrow with our coverage is a huge deal. But I'm sorry, I've said this for weeks. It's about earnings. They're better.
And the earnings from UPS, GE, 3M, as our team here at Bloomberg say, Tom, the beat goes on. Beats across the board. And Lisa, after the battle a little bit later, the juggernauts, the tech titans, pick a name. I don't care what you call them. They're huge, and the numbers have been stellar over the last 12 months.
And that's the issue, is that numbers are expected to be stellar, and it's going to be the other issues. How much of a concern is the China crackdown on tech? How much are we seeing an increase in digital ad spending? How much do we see an increase in cloud use? Because people have just basically played into this story of the new cyber world. How much do we get confirmation and acceleration going forward? And what does that say for the other sectors as well, John?
There we go. It's nice to get the counterpoint. Lisa, thank you. Your equity market down 6 on the S&P 500.
Looking around corners.
We decline, I know, down a little more than 1/10% outside of the equity market into bonds. Lisa, yields lower by 2 or 3 basis points on 10s, 126.28 outside of that. In foreign exchange, just quickly, dollar stronger, euro weaker, euro dollar, Lisa, 117.87. We're negative there, 0.14%.
Yeah, and you talk about those yields, and that is the counterpoint, frankly, to the new record highs that we're seeing time and time again on big stocks in the United States. This idea here of what is this telling us? Can we get any signal from this, or is this just a Federal Reserve with an $8.2 trillion balance sheet sticking its thumb on this market? Today, we do get some economic data. U.S. durable goods orders for the month of June. There is an expectation for transportation equipment to really bolster these numbers. There could be weakness in other sectors. However, to the degree that there is, it's due to supply chain disruptions, labor shortages, other things that we talk about quite a bit, and don't necessarily mean that there is a bearish tilt to the economy. I just want to note that I was pointing out the positive that could potentially be in that data. Just want to make that note. 10 a.m. we get U.S. July consumer confidence data.
Me too, aspirin.
And this is going to be a compelling read on people's confidence in getting jobs. There continues to be friction here with respect to the participation rate, highly suppressed relative to where we were pre-pandemic. We are not seeing those jobs come back online. People have speculated that it was due to the enhanced unemployment benefits, that it was due to childcare. What is it, and how much is that actually giving some consumers pause? And then, of course, after the bell, as we were just talking about, we are getting the big tech juggernauts, Apple, Alphabet, and Microsoft all coming out. The key issue is, yes, the forward projection, but also what their view is on salaries, on supply chain disruptions, labor shortages, things that are endemic to the entire market. If they give some commentary, they could be the leaders, frankly, because others have to compete, John.
After the bell, looking forward to the coverage coming up on Bloomberg TV and radio a little bit later this afternoon. Most people in this building would call me a humble guy. Extremely humble, and always willing to listen to really smart people. And here's the first line in a note that I got from Julian Emmanuel. His guest notes, just the first line, Tom. John is right. So let's start there. Julian Emmanuel, BTIG Chief Equity and Derivatives Strategist. Julian, let's start there. Why is John right?
Because, John, you've been saying this for quite some time now, that, just asking the question, why can't you just be a passive S&P 500 index investor in a world where, if you look at 2021, active management, as we heard from guests earlier in the show, has been giving you headaches for the most part, at least the last several months. The answer is to us, because if you're just simply a passive investor, you sort of are open to this range of emotions that, frankly, if you look at the course of investing over the last 12 or 13 years, certainly since the bottom of the financial crisis, you have to be in the psychological mode to where you're buying the dips. It's very difficult to say, I'm going to commit cash in March of last year. Very difficult to say, I'm going to commit cash in March of 2009, the times when you really wanted to do it. So either having something that causes you to outperform to the upside or outperform to the downside gives you that psychological edge to do what we think you're going to need to do and want to do for a number of years to come.
I should be very careful here. I'm not making a trade recommendation. I want to be clear about that. Julian, you're the man who's got to do that for me. Work through it now then with me. Got all these issues on the horizon at the moment. How COVID cases play out. Do they translate into higher deaths, increased hospitalizations, maybe more restrictions on the economy that just turn down the dial on mobility? Then you've got the China factor as well. It's just worry after worry. Julian, just piling up as always. And this market keeps climbing that wall of worry to all-time highs. How do you navigate those issues?
So again, look, the price action tells all right now. And the price action even though it is telling a somewhat contradictory message that at the headline, the S&P 500 continues to rise, very much propelled by the NASDAQ. Within the NASDAQ, very much propelled by a number of stocks, all of whom we're going to hear about earnings over the next 2 to 3 days. But there is starting to be a diminution amongst the rest of the troops. Breath has turned a little bit soft. That can continue. But frankly, from our point of view, when you look at the bigger picture, when you've seen the kind of economic strength that we have seen build over the course of the year, whether this is the peak of growth or not, the implication is stocks are likely moving higher over a multi-year period from here.
Julian, you look at the dynamics that are out there, the derivatives and all that. Let's look at the one derivative, which is cash on a balance sheet. Today, this afternoon, the three big ones, Microsoft, Apple, the other one, Google, 135 plus 125 plus 204 gazillion dollars. These guys could top trick $500 billion cash in their report this afternoon. What's the social good of all that money should they return it to shareholders?
Well, look, they are, for the most part, slowly through buybacks. The signaling of sort of a special dividend or something like that from companies like that are poised for continuous growth, secular growers, has tended over time not to be good. You can argue about the social good, but I think, frankly, what you're going to hear from them is, ways of getting stakeholders more included in the debate rather than just shareholders. So talking about wages, talking about employment programs in an economy that, frankly, confounds people because of the lack of the return of the participation rate in a market where there are jobs incredibly plentiful.
Julian, what signaling power does the bond market have for equities at this point?
Lisa, that is the, $20 trillion question, the size of the U.S. economy. From our point of view, it's really rather limited. Look, obviously we know that the Fed has, as you said earlier, put their thumb on the bond market. But also, when you think about it, all the extraordinary monetary and fiscal stimulus has come together to chase asset prices higher across the entire range, whether it's commodities earlier in the year, obviously stocks, goods prices, i.e. inflation, or the bond market. To us, it's all the wall of money. And the question is policy or perception likely to change? And our view is that you could get to a point where if the labor market does sort of remove the logjam that we have come the fall, which is the Fed's expectation, in an environment where the Fed is not likely to advance the taper conversation materially this week, you could see yields start to rise in the long end.
Julian, just quickly, are you still at 4,000 year end on the S&P?
We are, and here's the reasoning, John. Again, as I said earlier, this kind of economic strength, while it bodes very, very well on a multi-year period, doesn't necessarily mean that corrections don't happen. We've gone quite some time without a correction, and frankly, we're concerned about some of those internals, the lack of breath. And we think, actually, if you look at it, this could be a week where there's a potential for a surprise in terms of reaction from the large cap tech stocks, which have been doing all the heavy lifting.
Interesting. They start reporting in earnest a little bit later after the close. Julian, thank you, sir. Julian Emanuel, BCIG Chief Equity and Derivative Strategist. Julian, love catching up with you, sir, as always. 4,000 year-end on the S&P. Lisa, I know, we'll get there. Don't worry.
We have to address this.
4,300 is the median estimate on the S&P 500. I can stretch this one, Lisa. This is called the filibuster. Just before I finish, David Costin of Goldman Sachs out, going into last weekend. I think we're at 180 days now without a 5% drawdown. So drum roll. Could this be it, Lisa? The tech earnings coming up a little bit later. I'll put it on a plate for you.
Thank you.
Go on.
Well, the filibuster is that if anyone wants to get on the show, just send us an email that says, John is right. John was right. John knows all. And then you will come on this show and we will lead the segment with that, John. So you can keep filibustering now.
Let me tell you, if I had to call this market the way Julian had to call this market, I would be absolutely terrible at it. Better off sitting here and asking her questions, Lisa. The S&P down 5. We're negative a little more than 0.1%. Yields come in 2 or 3 basis points at 126.28 on 10s. From New York City, what a lineup we've got for you. Big tech reporting after the close a little bit later. We have Apple, we have Microsoft, we have Alphabet too. On radio, on TV, this is Bloomberg.
With the First Word News, I'm Laura Wright. The two Koreas have agreed to rebuild ties. That could lead to a possible opening for President Biden to push for a breakthrough in stalled nuclear talks. North Korea's Kim Jong-un and South Korea's Moon Jae-in have been exchanging letters. They have reopened hotlines that had been silent for a year when Kim's regime symbolically blew up a liaison office funded by South Korea. In Tokyo, a grim new record. The number of coronavirus cases in the Japanese capital hit a record today, more than 2,800. The surge comes as tens of thousands of visitors are in Tokyo for the Summer Olympics. Only about a quarter of Japan's population is fully vaccinated. In the UK, scientists are welcoming a sustained fall in coronavirus cases. They just don't know what's behind it. One day last week, there were almost 40,000 new cases. Yesterday, there were fewer than 25,000. That's a boost for Prime Minister Boris Johnson. He's been criticised for lifting restrictions early last week. President Biden says the American combat mission in Iraq will be over by the end of the year. Still, the U.S. is expected to keep a military presence on the ground. The president met with Iraq's Prime Minister Mustafa al-Kadhimi yesterday. American troops in Iraq have been gradually transitioning into an advisory and training role. Second quarter earnings at United Parcel Service beat expectations. The package shipper is sticking with its capital allocation plan for 2021. That's likely to be a relief for investors who were spooked by FedEx's plans to spend heavily on beefing up capacity. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common
in-
line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing
This
that I
is a
mentioned and you
big
carried on talking
physics
and
thing.
ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We will not flinch when our interests are threatened, yet we do not seek confrontation. So let me be clear. As Secretary, I am committed to pursuing a constructive, stable relationship with China.
That was the U.S. Secretary of Defense Lloyd Austin speaking earlier this morning in Singapore. From New York City, for our audience worldwide this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. As we count you down to the open about 2 hours, 12 minutes away, your equity market on a 5-day winning streak on the S&P 500. Down just 5 points now. The mood music improves. Equities off the lows, down just 0.1%. Yields off the lows, down 2 or 3 basis points to 126.11. And the earnings beats are piling up, Tom. UBS, GE, 3M, take your pick. They look decent.
Pretty much expected in a boom economy. We'll have to look forward to the view to Q4 and particularly those conference calls this afternoon. Bloomberg will give you complete coverage starting, call it 4 p.m. I believe the close will show up to do that, and the conference calls will be fascinating. Right now, let's tie in Lisa Abramowitz's observation on labor participation, Julian Emanuel's enthusiasm for the market, waiting for a jobs recovery, with our Jack Fitzpatrick on Washington politics. The chart is labor participation of the core audience 25 to 54. For those of you on radio, there is a nirvana of 2006. Things changed. It finally got better, and the pandemic absolutely crushed labor participation. There's been a somewhat recovery so far. Jack Fitzpatrick, politics is all about jobs. Fold in this infrastructure ballet with the need for jobs.
Well, the infrastructure bill is being cast broadly, really by both parties, as an attempt to create jobs. There are going to be a number of provisions. There are a lot of talks now on how they set the wages, the focus on American jobs, American steel, et cetera. A lot of the other conversation about labor force participation in Washington, as you know, has come down to the debate over the unemployment insurance boost that the president lately has essentially sidestepped and said, hey, that's going to end in September either way, regardless of the criticisms from Republicans. So really, the Biden administration and Democrats are very much all in on a jobs message in their biggest legislation that they're pushing. But obviously, there is a real partisan battle as it pertains to the labor force participation rather than the creation of jobs.
Well, what's so important here, it's a Bloomberg focus. I mean, Apple's going to come out with earnings today. There's going to be a huge uproar about cash flow. Nobody in your world cares about tech cash flow, do they?
No, that is not really the topic of conversation. We've got a few things on our plate in Washington. One is infrastructure. The next is essentially human resources, everything the Democrats have talked about, including taxes for the next big bill.
Yeah.
And then when you look at that chart, really, I think the number one debate in Washington has been the unemployment insurance, but that's essentially fizzled out with that set to expire.
I mean, Lisa, you absolutely nailed this earlier, that I'm sorry, there's a huge discussion here about a lack of a labor economy within a boom cash flow driven market.
Yeah, which really raises a question about the dominance of some of the largest companies, and was one of the reasons why I thought that yesterday, the fact that Aon canceled its $30 billion planned takeover of Willis Towers Watson. It was this combination of insurance brokers. This idea that the antitrust department torpedoed it was significant. Jack, do you get the sense that there is going to be more of a crackdown on some of the big tech juggernauts, as Tom rightly mentions, that the cash flow that we're seeing doesn't necessarily affect those other metrics that are key for the overall economy?
There is a broad concern about big tech companies. So, you know, there've been markups of antitrust bills. Sometimes it is a cross-cutting political issue with support in both parties. Really, right now, if you're watching for some significant action by Congress, the question is, how does something become law? And there's not exactly a glide path in Congress for really significant changes in the area of big tech regulation. It's something that is building in Washington, and you could probably argue there is some more bipartisan interest in it than there had been in previous years. But it's not exactly the top of the ledger for legislation in Washington right now.
Jack, this is a delicate question, but I'm wondering whether China's crackdown on the big tech companies there have any effect on the U.S.'s willingness or not to take similar actions, albeit perhaps not as extreme, in their country.
That would be a tough one to answer, to be honest, to try to play out how that would extend to the U.S. policy. A lot of the conversation in Washington really is just driven by what members see in polls, at least when it comes to Congress. If there are more minor things that the executive branch already has the authority to do, that's a different conversation. To be honest, I'm not exactly sure how to answer that one. I think the big tech conversation right now in Washington is politically driven by a frustration and a skepticism with big companies and on the tech side. I'm not sure if it's necessarily driven here by China's approach or our reaction to China's approach.
Jack, thank you, sir. Good to hear from you down in Washington. Bloomberg government reporter Jack Fitzpatrick there on the politics of the moment. Let's take the politics and bring you a market call. This from Morgan Stanley from over the weekend. Improving prospects for the passage of an infrastructure package by the U.S. Congress would put pressure on yields, upward pressure. Tom, they're looking for 180 on a 10-year still. They're sticking with that call year end. Right now, 126.
A lot of people are going to put out a whole set of calls. That's what makes us go, John. And I would suggest after today, really beginning at 5 p.m. this afternoon, you may see a reset. How many people, John, are going to lift SPX if they deliver?
What, do you remember the numbers this time last year? For a quarter that was really, really tough in Q2 of 2020, and they knocked it out of the park. Yeah. That was one of the most phenomenal earnings seasons I've ever seen, Tom.
John, let's talk about this. I think it's important. I like this idea that people are gauging percentage moves off 2 years ago. I sort of like that convention.
The 2019 comps.
Yeah.
I think that makes a lot of sense, though, doesn't it, Tom?
I agree.
For the tech players, though, they've proven they can make money if we're shut down. They can make money if we're reopening. Yeah. And for the likes of Facebook, who deliver earnings on Wednesday, we had earnings from Snap and Twitter last week. At least that really set the stage for better ad revenue for some of these companies. And Alphabet's been part of that play. Google's been part of that play. Let's be clear about that. We talk about these secular growers, all of that good stuff. There's a real cyclical story at play here for some of these big tech heavyweights too.
The story makes perfect sense. I buy it. The question is, what's priced in, right? Because if you talk to anyone, they say that's priced in. Earnings momentum for the next 3 years, priced in. And it's very hard to gauge what we're even measuring against when a number of the conventional metrics have kind of been thrown out.
Alphabet up 0.6% in the pre-market. Is the price action more broadly for you? We're down 6 on the S&P 500. We're negative a little more than 1/10 of 1%.
Yeah, just went green.
Yields off by 3 basis points at 126. And the NASDAQ 100 just turned positive. There you go, Tom. I'm getting there. Up 6 with positive 0.04%. There's a lift. The mood music improves as this session grows older. From New York,
this is my entry.
This is Bloomberg.
biggest debate happening in the business world right now is how to get workers back to work and what benefits to give your employees. Microsoft is asking employees to be back in the office 51% of the time, but you're flexible about the rest of the time. Is that a permanent policy? And for those companies that are saying you have to be back in the office 100% of the time, are they on the wrong side of history?
I think we at Microsoft, we want to be much more data-driven. I also think that in time, if a year from now, we will have more sense of what the real structural change and needs and the expectations of both our employees and our customers are. And we'll really think about long-term policies based on, quite frankly, having all of that data behind us, because otherwise I think we are trying to come up and being too overly dogmatic when I think we need to be more experimental in our approach to return to work, because I do fundamentally believe the world's changed.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Live from New York City for our audience worldwide on TV and radio. Good Tuesday morning to you. Here's the Tuesday morning price action. The mood music improving as this session grows older. Your equity market turning positive on the NASDAQ. We're up 6 on the NASDAQ 100, positive 0.04%. All-time highs into Tuesday. We could add some weight to it, maybe. On the S&P 500, we're down just 6 points now, negative 0.13%. The earnings, part of the story this morning, the likes of 3M, GE, Caterpillar still to come. So far, so good. Beats across the board. That's given us just a little bit of a lift elsewhere as well. That's the equity market. We've got to work through a range of issues. After the close, we'll hear from the likes of Microsoft. We'll hear from Apple. We'll hear from Alphabet. Those three names alone, 25%, almost a quarter of the NASDAQ 100. Just one of the issues for after the bell a little bit later. Switch up the board. Here's another one. 2s, 10s, and 30s. The view from Morgan Stanley. If we get that passage of an infrastructure package, we can get yields back towards 180 by year end, maybe. Here's your 10-year right now, 126.28.
That's a long ways away.
Yields in by 2 or 3 basis points. It feels like a lifetime away, Tom. We've got, what, 4 or 5 months to get it done.
Exactly.
Your bond market on 30s, 190, 144, yields in there by 2 or 3 basis points. Just another one of the issues we've got to think about this morning. Here's the final one. China. Switch up the board and get to this. This is where I want to sit for a moment, Tom. Let's work through it together. Dollar China, dollar yuan, back to 650. Just a little bit of weakness this morning on the Chinese currency side of things. And let's just sit and play with that, Tom, because if you're going to start to worry about a regulatory issue becoming an economic growth one and a transmission mechanism for this to bleed out through risk assets, you want to look away from Chinese equities just a little bit. That's where the headlines are, Tom. You've got to start looking at what happens with the Chinese currency, and it is such a small move so far after a monster move of Chinese currency strength over the last 1 year. But if that broader de-risking starts to emerge, you'd expect to see it in the FX channel a little bit more, Tom.
I'm in the camp, John, and this is from personal experience in Beijing, that it's really away from the equity markets and it's much more about the financial relationships of private enterprise, the SOEs, and also, of course, the banks, both the real banks and the illegitimate banks in China. That stew of issues is way more important than equities.
And we're not there yet in foreign exchange, let's be clear. 650.55 on dollar China overnight. That's the story more broadly cross-asset. Ton of earnings to get through with those numbers. Here's the man himself. Hello, Romain.
Yeah, good morning, John. A lot of earnings on the U.S. side here. Of course, we did get those UPS earnings. It was an interesting move here. We saw a 14% adjusted operating profit of sales. That's a bump higher than what the street was looking for here. They were looking for about 13.2%. The turnaround for Carol Tomé, that appears to be going as planned here, but investors want to see maybe a little bit more momentum. You're seeing the shares down about 2.5%. With GE, it's a totally different story here. Investors do seem to be all in on Larry Culp and the turnaround there. Of course, he is approaching approaching his 3-year anniversary here, and he has refocused this company as an industrial business. And I should point out that cash flow from that industrial business right now is going to come in a lot higher than what the street was expecting, about 20% higher. That's the forecast, going to be at the top end of a range of around $5 billion. A lot of that because of the commercial aerospace business that Culp has really centered this company around. Of course, we also got 3M results as well as Tesla last night. That also impressed, the big milestone for that company. It actually surpassed $1 billion in net income on a quarterly basis. First time it's done that. Now, of course, we flip with the board and look to after the bell tonight. It's going to be, of course, the biggest companies in the world out there. Apple and Microsoft, the 2 largest companies out there by market cap, going to be reporting. For Apple, it's going to be all about that product pipeline, specifically what happens for its fiscal Q4 and whether that new iPhone 13 comes in that quarter or they push it back to fiscal 2022 fiscal Q1. I'm going to get it out, but there it is. But the street is looking right now for about 90 million phones produced in that quarter. Whether that slides to Q1 or Q4, that'll be a big determinant of how the shares react. Microsoft, this is all a margin story really here. This company has really knocked it out of the park with regards to its cloud computing business, where remember, there was a huge accounting change in the previous quarters that allowed for that gross margin expansion. That's not going to be there when they report for this quarter. It'll be interesting to see how the street reacts to that. And then, of course, keep an eye here on Starbucks here. This is also going to report after the bell. And this was a company that really did well with regards to keeping its customers tethered to the business, despite the fact that most of its stores were closed. The digitization, the off-premises sales, they did well. But now the costs are going up high. We know their labor costs are going up, and of course we saw the price of coffee beans go up about 25% in the quarter alone, Q2, and they've gone up about 39% since the quarter ended. So it'd be interesting to see, keep an eye on their forecasts, guys.
Romain, thank you. We'll look for that in the close this afternoon with all sorts of good information from those conference calls as well. Right now for Global Wall Street, Ian Lingen joins us with BMO Capital Markets, head of U.S. rate strategies, a hyper-dense morning note, always read worldwide. Ian, I'm going to go right to a single sentence you have, which suggests the demand for bills, notes, and bonds. And that is the backstop of demand you see out there. Define that backstop.
Well, Tom, I certainly think that if we look at the primary takedown of Treasury supply via the auctions, we continue to see a willingness to underwrite Treasuries, whether it's from domestic accounts, primarily banks and investment firms, or overseas, central banks in particular. These auctions continue to see strong sponsorship, and that at a minimum suggests that there will continue to be a backstop of demand that isn't really going away anytime soon. It's less about whether or not there's a willingness to absorb supply and more a function of what levels will we see these takedowns. And with 10-year yields at 125, it's very difficult to argue it's not a strong market for U.S. debt.
Ian, what needs to go right, or wrong for that matter, to get 10-year yields to 180 from 126, 180 by year end? That was a call from Morgan Stanley. What would need to happen for that to happen, in your mind at least?
Well, in my mind, I don't think that it is as simple as passing, for example, the infrastructure bill, because that will be staged in over time and not actually lead to the type of wage inflation that the market would need to see for inflation in and of itself to become self-fulfilling. The one key aspect of this recovery that has been missing thus far has been wage inflation. If we see the labor market participation rate continue to be low, and there are pockets of labor scarcity over the course of the next few months, we might see spikes in wages, which would then get the market excited about the idea that inflation could be self-fulfilling. But I'll argue even that would fall into the Fed's characterization as transitory. We really are coming out of a massive shift in the real economy, and there's a lot of different moving pieces yet to be resettled where they will be going forward.
Ian, this is really important. Tom and Lisa were discussing it a little bit earlier. The failure to see real continued improvement in things like the employment to population ratio, the participation rate in America. If we don't get that improvement, if we don't get back to where we were, say, how much would that complicate the outlook for this Federal Reserve, which, to be fair, is pinning its forecast on the idea that we do fully recover on those aspects?
Well, I think it will very much complicate the Fed's path for rates going forward, because on the one hand, they've acknowledged that inflation has come in stronger than even they were expecting. But on the other hand, under their new framework, the Fed needs to remain accommodative for, frankly, the foreseeable future until the unemployment rate gets to the lows that we've already seen. And within that, we are assuming, and so is the Fed, that the labor market participation rate slowly starts to increase. If you don't see labor market participation increase, then you'll continue to have this surplus supply of workers that if there isn't enough incentive for them to slowly come back into the market, will really leave the Fed at a loss in their new framework.
At this point, given the Fed's intervention, is the bond market accurately reflecting the fundamentals?
I think at this moment, the bond market is reflecting the realities of the Delta variant, not so much that it's going to lead to increased lockdowns or the revival of restrictions in the US, but rather it's a reminder that these variants, the potential for these variants are going to be with the real economy for a while. And so while we might have brought into the beginning of this year the assumption that after Labor Day we'd be in the new normal, the reality is we're going to continue as an economy and globally and domestically to deal with the pandemic. So it's extended the timeline out of the pandemic. I think that's why rates are where they are at this moment.
Just real quick, do you expect negative real yields to go even more negative as inflation expectations continue to pick up?
As long as nominals are contained, inflation is drifting its direction, and the Fed doesn't hasten the departure from QE, there's no reason to expect that we couldn't see real yields continue to drift lower. I think 10-year or 10-year TIPS yields at negative 125, which would be another 15 plus basis points from here, is something that the market needs to have on the radar as a risk.
Ian, thank you. Good to get your view on this market, that's for sure. Ian Lingham there, BMO Capital Markets Head of US Rate Strategy. Just want to turn to some news from AP. Four-time gold medal winner from the Rio Olympics, Simone Biles, out of the team finals with an apparent injury. Tom, this coming from the AP about 15 minutes ago. Simone Biles out of the team finals with an apparent injury.
The New York Times with a wonderful feed here, minute by minute and tick by tick of this close competition of China and Russia in the United States. And what they discern here is that she was working on some of her weaker things when she really failed. I mean, in one of the warm-ups, there's no other way to put it.
And to be clear here, Lisa, one of the few, in fact, maybe the only athlete I can actually name at these Olympic Games this year.
I'm right there with you. She has won the most gold medals. She is a Spitfire, 4'8". Just her story is tremendous. John, I've actually watched biopics about her because her story is so interesting, and how the people who are fostering her just saw her flipping off of things and saying, okay, this girl needs to be in gymnastics. She's got a lot of energy and a lot of skill, and she certainly does. And unfortunately, she's out of the running with this year.
A phenomenal woman, phenomenal athlete. Simone Biles is out of the Women's Olympics gymnastics team final in Tokyo. Some reports suggesting that to be true in the last 10 or 15 minutes. Coming up, Congressman Kevin Grady, the ranking chair of the House Ways and Means Committee. That conversation up a little bit later this morning. Your S&P 500 down 4, call it 5. We're negative 0.1% on the S&P. Yields in a couple of basis points to 126.28 on 10s, and a ton of earnings after the close today. Full coverage on TV and radio. Apple, Alphabet, and Microsoft on deck after the close. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. Breaking news from the Summer Olympics in Tokyo. As John and Lisa were just saying, according to the Associated Press, US gymnastics star Simone Biles has withdrawn from the team event because of an injury. No word on what the injury is. The New York Times says Biles withdrew after faltering on her first apparatus of the final. On Capitol Hill, those talks to come up with a bipartisan infrastructure spending bill have run into a number of obstacles. Senate negotiators ended the day still trying to resolve differences over transit funding, water projects, and how much unspent COVID money can be used to pay for infrastructure. Lawmakers insist an agreement is still possible. New back-to-the-office mandates from California and New York City. California will require all state employees to prove they're vaccinated or wear a mask in the office and get tested for the coronavirus at least once a week. New York City is doing the same for its municipal workers. Shares of General Electric are rising. Growth in GE's jet engine division prompted the company to raise its cash outlook. That's led to optimism that improving air travel will give a boost to CEO Larry Culp's turnaround efforts. The petrochemicals division at ExxonMobil is supercharging its financial turnaround. The often overlooked segment of the oil giant's business will probably post a record high earnings this week. That's because of the surging prices for plastics. Demand for products such as packaging and materials for flooring held up during the pandemic, and they've risen during the reopenings. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I've always sort of pictured what it was going to be like. I mean, you know, like the ride up there, the ride back. I never realized that the whole experience was going to be so vivid.
But beyond sort of the satisfaction of your own goals being achieved, what does today symbolize for the company and also for all those children that were present earlier?
Well, look, for the children, we've just got to get building as many spaceships as we can, as fast as we can, so that one day those kids will have the chance to have a similar experience to what I had. And that we will do. We also launched this giant global raffle today, so that, you know, two kids for, you know, just $10 for a pair of tickets. If they could win the raffle, they can go up. But that money will hopefully enable many people to be able to go up who could never have dreamt of going to space.
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Valuations, particularly, you know, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We need to be thinking about what is that trend rate of growth after sort of the deceleration? And the deceleration that we're seeing, while we may have expected it, it is coming a little more quickly because of the rise of this Delta variant. We will see ultimately some reacceleration in growth.
Great to catch up with Gene Sanuzzo there, Columbia Threadneedle Global Head of Fixed Income from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Tuesday morning, all-time highs going into Tuesday on the S&P. A record on the NASDAQ. We're down just 6 on the S&P. We're negative 0.13%. The NASDAQ 100 just about positive now on the session. The mood music improving as this session grows just a little bit older. Yields come off the low, still at 125.94, Tom. Yields in 3 basis points on a 10-year, and crude unchanged at $71 and about 92 cents.
Waiting for the VIX to come in as well, near a high 19 into 18.36, up 0.78 points, and you got to believe that's going to grind in as we get towards the market open. David Wilson is good enough to know that a sample size is 30. Anything under 30 data points, you go, maybe. He goes this morning where few tread. A sample size less than 30. What do you have?
Well, okay, I've got a sample size of 5, but it's not just me. It's Carter Worth over at Cornerstone Macro. Yeah. He had a Twitter post out yesterday looking at weeks when you've had sort of the big 5 of technology all reporting, as is the case this week, considering we've got Apple and Microsoft and Google's owner Alphabet due to put out results today, Facebook tomorrow, Amazon.com on Thursday. So that's happened 5 times since 2015, and every time you've seen the S&P 500 either fall or not rise. I mean, last time was in April, and it was up 0.02%. That's about as little change as you can get. You go back to October, 5.8% decline in the week that all those companies reported. So it's not like the fact that we got all these numbers coming out is necessarily a plus for stocks.
And folks, the profanity from our headline team when they're putting this stuff out, I mean, they're moving at light speed. And I've actually had the headphones on listening to our headline team get this done. And David Wilson's actually led all this coverage. They come out with earnings. We all see that. And then there's Top Live, and then there's the conference calls. Are the conference calls important to you?
They are, because they kind of fill in some blanks in a lot of cases in terms of how companies are looking at their business, what they're anticipating going forward. That's really the key, because, you can look at the basic numbers and draw conclusions, but at the same time, I mean, like 7 out of 8 companies in the S&P 500 are beating analyst average earnings estimate, and a similar number are coming out ahead on sales. So that doesn't necessarily tell you all that much anymore. So you really have to kind of get a sense of, how does the business look going forward, and what do companies focus on? What do they talk about? How are they dealing with higher costs, for example? That's the case for a lot of businesses at this point, the inflation sort of situation and how they're dealing with it.
Dave, we've gotten used to this. It's the same story over and over again. These companies report blowout earnings, and the shares barely move or even fall, and people say it was all priced in. How do we even begin to know what we are pricing in ahead of these earnings?
Well, that's the challenge as much as anything. You do have to bear in mind, though, the S&P 500 has been setting records lately, and we've seen earnings estimates for the second quarter going up even before companies come out with their results. Then they beat projections, and it's kind of like, okay, this is what we're anticipating. And we are getting some positives, though, out of the results. I was looking at a report from Lori Calvasino at RBC Capital Markets that if you look at the average S&P 500 company that beat earnings estimates, it's been up like 0.3%. But you look back at the last 3 or 4 quarters, you didn't even get that. So, there is a sort of a positive spin, you might say, coming out of these results.
All right, Dave, I'm not wearing a tan suit, but I have been hanging out with Tom Keene a lot, so I do want to rip up the script a little bit and ask you about the contagion factor from the sell-off in Chinese equities, the question of whether there could be some sort of transmission mechanism. What are you hearing from the analysts that I know you speak to all day long in terms of what that transmission mechanism could be, whether there could be contagion or whether this truly is an isolated event that is really providing perhaps an excuse for on the margin cashing in on positions?
Well, more the latter, because so much of it is tied into the regulatory situation in China. you can draw parallels, I suppose, to some extent to what's going on in the U.S. With the look at the big tech companies and whether they should be as big as they are in terms of antitrust situations. That said, I mean, talk is one thing, action is another. We're certainly seeing action in China, whether it's Didi Global, the ride-hailing service, or it's the online tutoring companies, or even food delivery. There's a company called Meituan that's being affected by changes in regulations there. So talk is one thing, action is another. We're seeing a whole lot more action in China.
We'll see the action this afternoon on earnings. David Wilson, thank you so much. Greatly appreciate that. John Farrow, we've got a setup of 3 economic datas, durable goods, into housing, into the conference board as well. You wonder how that folds over into the real yield analysis.
Well, let's frame the world right now according to Goldman Sachs and then get the other side of things from JP Morgan on market strategy. Tom, we talked so much about the Goldman call yesterday, and for our audience worldwide on radio and TV, if you missed that, here was the quote. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. What does that mean for your market call? Well, JP Morgan pushing back a little bit against that. Marko Kolanovic and the team, Tom, going on to say, with UK cases significantly down over the last week, the peak appears to be behind us, which could be a signal for the rotation back into value, reflation and reopening themes.
Wow.
For many people looking to the UK, it's the UK case study that gives them a forward look about what they think may or may not develop here in America, Tom, and what that means for your market call.
It is just a stew. I don't know what else to say about it, John. I have no conviction either way other than look at the data each day. And frankly, that's what Chairman Powell's doing. They are, I mentioned this, I believe it was yesterday, they are ex post like I've never seen.
So they've got to wait until when?
Wait and wait.
Well after September.
You know, to be honest, and I defer to the experts, they're going to wait 3 meetings from the identification of the data point.
This is why I don't get the Jackson Hole fuss.
Said that.
I don't get the Jackson Hole fuss because you've got to wait, Lisa, for the supply side of the economy to respond before you make a move on anything. And most people, most economists suggesting September is just the beginning of maybe the time when we'll experience that.
What's interesting to me is that the market participants are trying to look past the Fed and figure out what the pressures will be in terms of getting them to move more quickly than they're currently forecasting. And if you take a look at the Citigroup Economic Surprise Index for the United States, you can see that it's nearly the most negative since last June. If you look at that, this idea that perhaps people have been overly optimistic more frequently than they have over the past few months, it shows caution, right? And if it's caution, then perhaps the Fed is right to be hesitant. And I think that this is what people are looking at, not necessarily what the Fed will do, but what they'll be forced to do down the line based on where the real economy is going, John.
126 on 10s right now, 126.11. Yields coming in 3 basis points. Just to give you a bigger picture of what's happening with the markets right now, Tom. Equity futures in 8. We're down 0.2%.
John, major debate at Jackson Hole's Huckleberry pancakes or plain pancakes at the Pioneer Grill.
That's the debate. That's it.
That's a debate.
Nothing else matters for you.
Nothing else matters.
Why am I surprised? In fact, I am surprised. Is there a drink involved? What is the beverage of choice with that particular breakfast?
No, well, they serve Tang. I mean, it's a Pioneer Grill. They're going to get a Tang Mimosa.
Tang Mimosa. Crushing it, Tom. From New York, on radio, on TV, this is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tierney Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空间之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Under the surface, this has been a much more frustrating market over the last 2 or 3 months.
We're already in that decelerating upward revision pace, and about half the sectors are contributing to that right now.
You have to do anything you can to try to get money out to earn a positive real yield. I mean, that's really the point.
We just got to keep pushing on this recovery long enough to get back to where we should be.
This kind of economic strength, while it bodes very, very well, doesn't necessarily mean that corrections don't happen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television, news flow, extraordinary earnings this afternoon, the Fed tomorrow. John, what are you focused on?
All-time highs in the equity market. Keep going back to it, Tom. 5-day winning streak on the S&P 500, record high on the S&P, record high on the NASDAQ, and about a quarter of the NASDAQ 100 reporting after the close in just a grand total of 3 names, Tom. Apple, Alphabet, Microsoft.
The real yield doing a little better than the agony of 2 or 3 hours ago. Let's skip that right now. John, you and I don't hearken back to what people said a long time ago. We don't play the, oh, he was right, oh, he was wrong game. Can we go back to the brave, long ago and pandemic-y far away that said 3,700?
Let's go to the first week of November. I think the first week of November is really important. Okay. That's when the headlines around the efficacy of these vaccines first came out. The S&P 500 that morning at 3,300. That was around the time that you get the banks on Wall Street getting together, getting around the table and thinking about the year ahead, the outlook, your year-end 2021 forecast. I remember when Deutsche Bank came out at 39.50, when the likes of Goldman Sachs, we thought David Kostin was a crazy man at 4,400 on the S&P 500, Tom. We're at 4,400 right now, coming into Tuesday.
Well, we'll talk about that here in a moment. And, John, it does go back to the reaffirmation of earnings. John, would you suggest that Apple, Microsoft, Alphabet, Google, the rest of them really matter to the entire Standard & Poor's 500?
Absolutely, just for the weightings alone. If you mean for sentiment, I think that too, for this equity market. But more broadly, the tone has been set by what happens in the bond market. Where you want to be, growth, or maybe the cyclical, seems to be shaped for some people, not everyone, but for some people almost exclusively by what happens on a 10-year yield. And right now, we're at 125.94.
Lisa, we're looking at Washington almost with another stimulus in an infrastructure. And as you mentioned earlier, that wonderful idea on labor participation, it is two Americas.
It is two Americas, and that infrastructure bill, perhaps it is sort of eking its way through Washington, but not fast enough for some people. I want to just point out, Tom, you said that you were in cash. So was everybody else. There was data just coming out from the Federal Reserve showing that there are $17 trillion, you were pointing to this earlier, Tom, of deposits. This perhaps supporting all asset prices. What indication are we actually getting then at this point from markets?
Last number of days, overnight repos, what I call the trust market, that very, very short-term paper, up a little bit to go through 1 trillion. There would be a huge deal. John, let me do the real yields here across the data. The 10-year real yield, negative 1.14. We've improved a little bit lesser negative, but that residual, that inflation-adjusted yield, truly a record low.
I'll get to the nominal, Tom. 125.78 on 10s. Here's the picture of the markets for you. Yields in 3 basis points on a 10-year this morning. Your equity market off the lows, down just 6 on the S&P 500, negative 0.14%. Euro dollar unchanged, 118. Crude basically unchanged, Tom, just south of 72 at $71 and about 90 cents.
We talk to experts, and we particularly talk to experts of a quantitative bent who have incredibly detailed strategy, and that would be Bikram Chadha at Deutsche Bank, their chief global strategist, an informed pronote. We'll have him translated to the English right now, and thrilled he could join us this morning. How do you interpret or use the earnings from the big tech companies? What does it mean to you?
So there's several questions here. I mean, they're obviously, number one, a very large part of the market. And we've been living in a world now, this is the 5th quarter, where the bottom-up consensus has gotten beat by actual delivered earnings by the tune of 15 to 20 percentage points per quarter. And so far, this quarter is not looking that different. The headline beat, is close to basically 20%. A big chunk of that is a loan loss provision. So we're still talking about, in round numbers, about a 10% beat. So, beats are slowing. The bottom-up consensus has moved up. But as far as tech earnings go, I mean, I think the main issue here is, as you're well aware, the mega cap growth in tech companies have, very strong secular growth in their earnings. There was clearly some front loading, especially what you saw basically in the first quarter, a big move up, above about 20-25% above their prior trend that's been in place for 7 or 8 years. And so the big question really is whether that was a pull forward and we're now going to go slower and revert back to trend. And I would argue that if you aggregate the bottom-up consensus, that's really kind of the picture that, they have. And so we shall see. I mean, if you look at the broader equity markets and multiples, and of course, this also applies to mega cap growth in tech, I would argue that, the market's sort of pricing that, the huge upgrades in earnings that we've had, like I said, the beats of 15 or 20% a quarter are going to continue forever.
Let me translate that. He says, don't get out of triple leveraged all cash.
Stay where you are, Tom.
Stay where I am.
44.22 on the S&P 500. Binky, we started this hour by talking about where we started last year. For these calls going into this year, it was the first week of November. When you came out with 39.50, and I understand it's now 4,100 year end on the S&P 500, I also understand that a forecast by definition cannot be wrong because it is a forecast and we still have 4 months left on the calendar. I just wonder, so far through 21, Binky, what has surprised you? You were bullish. Many people were bullish, maybe just not bullish enough. What surprised you to the upside?
At the end of the day, I would say it's basically two things. It's number one, it's earnings and how strong they've basically been. And number two is, sort of how the market is treating those earnings and where we are basically in the cycle, I think it's important to keep in mind that this cycle has basically been proceeding, very, very fast, especially if you look at corporate America and where earnings are. If you look at things like GDP, you would say, the cycle's got a long ways to go. I mean, we're still waiting for Q2 numbers, and that might put us above pre-COVID levels. Look at it, things relative to sort of the trend in GDP, and we're still 3 or 4% below. And that suggests, there's a lot of upside for recovery. You do this for the S&P 500 at the industry group level. We've done it for 53 industries that sort of, cover the S&P 500. And I think that, the very stark, loud conclusion is that if you look at activity variables and revenue for about 2/3 of the S&P 500, we are well above trend levels already. So I think, this sort of characterization does a very good job of explaining why the equity markets have done as well as they've done. And so, the big question is, where do we go from here? Do we slow? Do we actually start to see negative growth?
And again, Lisa, what's so important here is I should stay in triple leveraged all cash.
Thank you. Thank you, Tom. That's important to know. There are a lot of people still in triple leverage all cash. And that's actually, Binky, where I wanted to go. This idea that there is so much, and I hate this phrase, but cash on the sidelines here, as people aren't fully invested yet. That is what so many people said. Really? How much will that spur valuations to even higher heights, despite the fact that all of this is already priced in?
Yeah, so I think it's really more about sort of, where multiples and earnings are as far as the cash argument is concerned. I mean, I think it was a very valued argument at the middle of last year, and we made the argument at the time. But now, if you look at cash levels and you look at it relative to the market cap of the S&P 500, it's actually on the low side as opposed to being on the high side. So, yes, I mean, in absolute amounts, there's plenty of cash, but what is the buying power, relative to the market cap of the S&P 500 is actually very low, I would say.
So, Binky, do you and the team get around the table a little bit later this afternoon after the close, go through these 3 big names and work out what's next for that forecast? Is there a rethink after the close today?
Yeah, I mean, I think that, this recovery has been like no other. I think, the principle has been to remain flexible. I mean, if you told me, 15 months ago that we were going to have 4 quarters of 20 percentage point beats in S&P 500 earnings, every quarter, I would have disbelieved you, but that's, exactly kind of where we are today.
Binky, thank you. Appreciate your time. Binky Chowder there, Deutsche Bank Chief Global Strategist on this S&P 500 on a big afternoon coming up stateside with the likes of Apple, Alphabet, Microsoft on deck, Tom, with earnings. I just want to get to a headline. It comes from CNN, citing a source. A federal decision on a mask mandate is imminent. This just coming from CNN, citing a source. A federal decision on a mask mandate is imminent, Tom. So expecting some news imminently, according to CNN, on that front.
And of course, Dr. Fauci's talked about this. You really wonder what that could be. I mean, what the details could be after what we saw from New York City and California yesterday.
We were told there was an active conversation. We understand that's happening. Lisa, we already knew that. Now we're waiting for an actual decision on it. And to Tom's point, there seemed to be an effort to leave this to local leadership. Maybe that's not the case.
Well, and that's been the case for a long time, that pretty much all of these policies have been left to localities. My question is, if they do come up with some sort of mandate, does that set them back from popular opinion standpoint? Because we have seen those protests around the country, around the world, frankly, about some further restrictions. You do wonder at this point whether people will just get more angry about this and protest.
Well, before jumping to judgment, guys, I think we've got to be clear. We don't know what that decision is.
Yeah, but
just
John,
according
to
to
your
a source,
point,
there will be a decision.
John, you alluded to it earlier. I mean, the political heat. If they institute a federal mandate, to me, that's unimaginable.
Well, especially Tom and Lisa's alluded to this point, for the vaccinated. An extra layer of restrictions for the vaccinated, that could be pretty complicated in this country. So that's the news. We don't have the news yet. Just a report. It's from CNN.
We like to get out front of the news.
A federal decision on a mask mandate is imminent, according to CNN, citing a source. Maybe we will have some actual news a little bit later. Just wanted to bring you the headline before we jump to conclusions. Equities down 8 on the S&P. We're negative 0.2%. You did too. Your 10-year yield, 125.28. Yields in 3 basis points on 10s. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. The two Koreas have improved the prospects for a breakthrough in those stalemated nuclear talks. North Korea's Kim Jong-un and South Korea's Moon Jae-in have agreed in letters to restore relations. They released what appeared to be coordinated statements calling for reconciliation on the peninsula. That happened on the 68th anniversary of the armistice that halted the fighting in the Korean War. In Tokyo, a grim new record. The number of new coronavirus cases in the Japanese capital hit a record today, more than 2,800. The surge comes as tens of thousands of visitors are in Tokyo for the Summer Olympics. Only about a quarter of Japan's population are fully vaccinated. Stunning news from the Summer Olympics in Tokyo today. Reigning gymnastics champion Simone Biles is out of the team finals after apparently hurting herself during the vault. The US star is widely considered to be the greatest gymnast of all time. Her absence will make it difficult for the American team to claim a third straight Olympic title. China's Tencent Holdings is suspending new user registrations for its WeChat services. That adds to uncertainty for the tech sector that's in the midst of a two-day sell-off. Investors have fled Tencent and its internet peers after China announced its toughest ever curbs on the online education industry. Beijing also issued a series of other edicts governing illegal online activity. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
In space?
What defines going to space?
There is a level where you
It's
get
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're on the verge of having platforms and companies that are so powerful and so influential in the political process that they're ungovernable. China has realized that this poses an existential threat to governance and law, and they've decided they have to stop it. We haven't gotten there yet in the United States, and I hope we get there soon.
Wonderful to catch up with Paul Romer there, the Nobel laureate and NYU economics professor from New York City this morning. Good morning, alongside Tom Keene, together with Lisa Abramowitz. I'm Jonathan Ferro, and here is your equity market this Tuesday morning. Into Tuesday at all-time highs on a 5-day winning streak. Your S&P down 9 points. Call it 10. We're negative 0.2%. Yields in 4 basis points on 10s. Your 10-year yield 125.11. Euro just a little bit stronger here, firmer. Briefly, some euro strength, 118.11, up by 1/10% there. Positive 1/10 on that currency pair. And just finally, Tom, crude unchanged, 71.91 on WTI. Going into a huge amount of earnings we're expecting after the close. I say huge, I'm talking about market cap. It's just three names, and they make up a quarter of the NASDAQ 100. It's Apple, Alphabet, and it's Microsoft too.
We're going to stop now and look at Apple. Will Power with us, with Baird, the senior research analyst, with a terrific note. And what's so great about Will Power, at the bottom of his note, he shows you his belief in his track record from another time. This is a guy who just before COVID, just before the pandemic, was outperform on 90, and Will Power sustained that outperform through thick and thin. Will Power, you sustain your outperform today. Simply, can Beijing upset the apple cart? Can Beijing, all this upset in China, derail your outperform?
Well, Tom, that's a great question. Good morning. Thanks as always for having me. Great to be on the show here. Look, China's always a big wild card, and at least at this point, has still been a big driver of Apple's results. And we're still not expecting that to change near term, but it's certainly something we keep an eye on with all the tumult that's underway in that country with respect to other tech companies. But at this point, Apple's been able to navigate that market fairly successfully. And of course, that's just one piece of the puzzle for Apple as you think about the broad-based strength we expect again, this quarter.
Well, as you know, the cheat guide to Apple over the last decade is just to buy it, to keep buying it, and then to keep buying it. It's complex on one front, though, and I've always struggled with it, and I'd love for you to guide me through it. What multiple do you put on a name like Apple, given the evolution of this company over the last 10 years?
Well, it's a great question. It's been one of the central questions, and I think a linchpin of probably if there's a bear thesis, is probably on the valuation accretion and multiple expansion that's occurred here over time. Look, we played a long game with Apple, right? And our view over a long period of time has been it'll continue to grow into valuation, and you're betting on their ability to continue to add new value-added services and solution for end customers. And that, in turn, continues to drive, more, shareholder value. Our view is that it increasingly, falls into the consumer staples camp, right? So that it's not a name that you can really comp against traditional, big cap tech, per se. And as you start to look at, consumer staples names, it's, we think you can justify multiple to get you closer to 30 times, which ultimately is what we're currently using to get to our $160 target price.
Well, this is an important point, the idea that you emphasize services. Does that mean that at this point, people are basically not looking for Apple to necessarily innovate with the Apple Watch or some other product that really has to do with ongoing revenues from either iPhone sales or from the services that you can get on the iPhone that will determine the future revenues?
Well, I think that's a great point. And look, I mean, services now is 20% of revenue. It's growing north of 20%. It has a much higher than average gross margin of close to 70%. And that's a big part of the story in terms of driving higher multiple than what it had traded at historically. And our expectation is that can continue. Look, I mean, I think just last quarter reported close to 660 million paid subscriptions on the platform. That's a number that continues to rise by 40, 50 million every quarter. And that's why it's critical that services like Apple TV Plus and things down the road continue to take off, because that helps drive that line of business for them. But of course, that's just one piece of it, right? The key to the story has been the consistent diversification beyond iPhone, which is now down to a little under 50% of revenue, but still, of course, the linchpin to the story and a big driver near and medium term still.
Would you like to see Apple become a media company? I mean, there's been so much speculation about their buying, let's say, a Netflix or some other big service provider that way to enhance their Apple TV. Is that still on the table?
Well, I think Apple TV Plus is very much on the table, as you know, right? Ted Lasso, of course, has been a great show, but they need a few more hits like that. I think at this point, it doesn't appear they plan to buy a major media company to kind of jumpstart that effort. I mean, look, hindsight's always 2020. Perhaps they should have done that. Perhaps they should have looked at something in the autonomous vehicle market. I think these are all things of intense interest as you go forward. Look, at the end of the day, part of the bet on this and the bet on the valuation is that this is a true platform that they can build off, right? And services and media are, key elements of that.
And now for William Power, for those of you on radio, we get out the HP 12C. Okay, you don't do a sum of the parts on Apple, but you do extrapolate out to some form of estimate off of $5.10. If I'm the gloomiest Lisa Abramowitz gloomy on Apple that I could gloomily possibly be, I would do a 15% gross up on this. If I do that 24 months out, Will Power, I'm at $202 a share with a $3.4 trillion market cap. Is that feasible?
Look, I think that's possible. I mean, look, at the end of the day, I think part of what's going to happen here, Tom, is, as I said earlier, they're going to continue to grow into the multiple. My expectation is, while we may not have the level of beat we had this past quarter, I think there's still nice upside to current estimates, both this quarter and as you move into the fiscal Q4. And look, one of the key things to keep in mind, we haven't really touched on, this 5G cycle is still super early, and it may not be the massive super cycle in year one. But if they've just sold over 100 million iPhones that are 5G capable against a global base that's close to 1 billion iPhones, that's a big upgrade opportunity still for multiple years.
John, that pause that Will Power gave you when I asked him that question is known as the general counsel pause. That's because he's really not supposed to extrapolate out 24 months.
He's got the notes written down, Tom.
Is my badge at Baird going to work tomorrow?
How to respond and what to respond to and what to ignore. William Power's going to go now. Baird Senior Research Analyst. Will, great to catch up. Appreciate your time, sir. William Power of Baird, looking for 160. That's the price target from Baird on Apple. An outperform rating. 35 buys on Apple. 8 holds, 3 sells. Lowest on the street, Pierre Ferragut of New Street. Surprised to see him down there with a sell, Tom. A 90 price target.
Yes.
At the close yesterday, just south of 150 on Apple.
And I got it out.
3, 2,
I
1.
can't go.
Mike Q, live.
An articulate bear is what he is.
A what? An articulate bear?
Yes.
Okay.
He's very, very good. With great respect, I listen to him.
That was great. And please, we reset the show for that. Bit of news coming from the US gymnastics team. The official statement reads as follows. For anyone following this, and I know many of you are, Simone Biles has withdrawn from the team final competition due to a medical issue. She will be assessed daily to determine medical clearance for future competitions. At least they go on to say, thinking of you, Simone, and I think it's fair to say we all are.
I was just going to say the exact same thing. A tremendous athlete and a tremendous figurehead for both gymnastics and the broader world.
From New York City, your equity market is negative 0.2%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Earth who are wondering, why are we investing all this money in space, this time in space? Talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
The curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here. Have you
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Live from New York City for our audience worldwide on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market -9, down 0.2%. Waiting for some economic data in the United States of America. 8:30 Eastern. Here are some of the numbers. With that data, here's Mike McKee.
Good morning, John. Well, we have an 0.8% increase in durable goods orders, which tells us that we're not adding to stocks as quickly as they thought possible, because the estimate was for 2.2%. Last month was 2.3%. The standard caution here, of course, is that durable goods orders are very lumpy. Durables ex-transportation up only 0.3%. So I'm guessing that transportation equipment was the big push for what we did get, the 0.8%. Capital goods, non-defense, ex-air, up 0.5%. That's the one that is basically the compilation of business orders that go into GDP. That is much better than the prior month's 0.1%, a little bit lower. Although we just got the revision, it was 0.5%, so basically no change. 2 months in a row of 0.5% gains in capital goods. Shipments up 0.6%. They were up 0.9% the prior month, so a little bit worse there, which will weigh a little bit on second quarter GDP, but overall capital goods up at a reasonable pace. The problem is here we expected more.
Durable goods durably fall on my foot and hurt it, to steal from Dennis Gartman this morning. Does this data, boring as it always is, but does it signal to you the shift from the goods sector to the service sector?
It could. It's hard to, without looking at the entire breakdown and looking over a couple of months, to know, but we do expect that in terms of just consumer spending, that's happening, but it's the business spending that people are concerned about. What's happening with inventories as companies try to build things up again. And inventories did increase almost a full percentage.
John Farrell broke yesterday worldwide the Goldman Sachs story, the idea of a delay here in service sector build out. Interpret their delay in service sector build out not to this single durable goods idea, but to the goods boom in America. Translate that.
Well, it's just that Americans spent so much money on goods going into or during the pandemic that now they can go out and spend money on services like going to restaurants or going on vacations. And so that pulls the money over there. The question is, how quickly can the service industry ramp up? And I'll give you a personal anecdote.
Oh, here we go.
Dealing with an airline that will be unnamed had a problem that they caused with my ticket for an upcoming trip, and it took me 7 hours to get through to a customer service
You were
agent.
on hold because Pharaoh was in front of you on that call right now. John, you've had the same problem.
Does it have the same name as a COVID variant, Michael McKee? That's what we want to know.
It just might.
Just wondering. Okay, Michael, thank you for that.
Very good. Michael
McKee
McKee,
on the
thank you
data
so much.
and the troubles of traveling in the United States of America. Equity futures, Tom, down 0.2%. Yields come in just a little bit off the back of that downside surprise. 124.28 on 10s. Yields in 4 or 5 basis points.
Housing data coming up, and then consumer confidence as well. Now to translate, Neil Shearing with us, Capital Economics, our group chief economist as well. Neil, what's your mystery of Q4 and into Q1 of next year? Do you have any sense of it, or do you just have to wait?
Well, the situation with the virus, of course, and the pandemic is changing very quickly. We're going to get Q2 GDP data later this week. In many respects, the market will be focused on that, but it's already old news, of course. The Delta variant since then has taken off in parts of Europe, concerns that might be spreading the other side of the Atlantic. So in many respects, it's very difficult to know exactly where we're going to be at the end of this year and going into next. With all that being said, I think, and we've seen more evidence of it in the June durable goods orders that we've just said, as you said, a bit soft. Growth is going to slow. To some extent, that's a bit inevitable, though. The point is that the economies have already bounced back a long way. We've already had the V-est of V-shaped recoveries, so it's inevitable that I think the growth is going to come off the boil over the coming quarters.
Neil, we've got a case study for how things play out with the COVID variant, the Delta variant, and what that means for the economy. What are we learning about how this is playing out in the UK?
Well, exactly. We've got the UK, we've got Israel, we've got a few places we can look to. The key thing is the extent to which vaccines are playing a role in breaking the link between, or weakening the link between, infection rates and hospitalization rates and deaths. And in the UK, there's been some extremely encouraging news on that front. Normally, we saw this kind of 2-week delay between infections rising, then hospitalizations go up, and then deaths go up. Whereas this time around, we've seen a huge spike in infections. They've been falling over the last 4 or 5 days, but before then, they've been really rising. The hospitalizations didn't rise. The NHS has not buckled under the pressure and the strain yet, and the government has pressed ahead with lifting restrictions on economic activity and movement. And of course, it's those restrictions that are important for the economy. So the case study so far is that vaccines seem to be working. The problem, of course, is that there's a huge disparity between vaccine rollout rates in different economies.
Is there a reason then, based on what you're seeing? And of course, a lot of this will come down to the tolerance of individual officials in different jurisdictions, but any reason, as far as you can see, Neil, that would lead you to downgrade your economic forecasts?
Not on the back of the Delta variant and not for developed markets. I think emerging economies are in a very different position because of the point that they've been much slower to roll out vaccines for all the reasons that we know. They've struggled to get hold of supply. The actual rollout, once they have got hold of supply, has been slower too. So I think emerging economies are much more vulnerable to not just the Delta variants, but other mutations of the virus. But in developed markets, it's a downside risk. It's pushed back perhaps the recovery in the UK by 4 to 5 weeks, something like that. Not enough at this stage. It's a rounding error, so not enough to fundamentally change our forecasts.
Neil, ahead of this week's GDP reading, there is a question about the distinction between inflation and growth and how these are not necessarily synonymous. People expecting growth to return to the trend line pre-pandemic by the end of next year. However, inflation still remains the wild card. What's your sense, and why are you worried about stagflation? I'm laughing because I know I'm going to get slammed for even bringing up the S word.
Well, exactly. We've said there's a whiff of stagflation rather than we're not kind of jumping all on the stagflation bandwagon yet. I think that it's important to distinguish between what still look like, I think, some temporary frictions in the system in terms of getting the economy back to work. Don't forget, we shut the economy, the US economy shut down for a couple of quarters last year, and we're just about to trying to get all these people back to work, millions and millions of people back to work. It's inevitable that there will be restrictions. There's been a huge rotation, you covered it earlier, in people's consumer spending habits from services to durable goods and then back again. So it's inevitable there will be some restrictions, and those restrictions on the supply side are now more clearly holding back output growth. And of course, one way they manifest themselves as well, because demand is strong, is in higher prices. So that is the essence, I think, of stagflation. This is not the 1970s stagflation. This is a very different type of stagflation, I think.
Well, this is a really important point, especially having to do with the deglobalization that we're seeing in some ways, with trade very much in the forefront of talks between the U.S. and China. How much is this still an underappreciated fact when people take a look at inflation expectations over the next few years?
Deglobalization, I think actually 3 or 4 years ago, we were talking about deglobalization. The world has had peak globalization. Trade, measured as share of global GDP, was topping out, perhaps capital flows too. I think that debate has now started to shift away from deglobalization and towards decoupling, US-China decoupling. This is not necessarily about the world deglobalizing now. It's about the world's two largest economies decoupling in many areas, not just trade, but also in finance, investment, security, defense, technology. In all of these areas, the US and China is decoupling. Now, I don't think that's necessarily a huge source of inflation. The biggest risk, in my view, to inflation is what's happening in institutions and in the Fed in particular. That holds the key in all of this. But it's certainly not helpful if we then see less globalization too.
Neil, with the meeting tomorrow, has the story changed? Has the news flow changed what we will hear from Chairman Powell?
I don't think it's fundamentally changed at this stage. I think it's pretty clear now that the best of the recovery, if you like, is behind us in terms of those big month-on-month Q-on-Q gains in output. I think perhaps some of the concern over inflation has eased a bit too. I think, and obviously what's happening in markets is fundamentally, that's the bit that has changed. Real yields obviously now record lows. The Treasury nominal yields coming down too. So I think the Fed is probably looking at the situation now and thinking we're sitting pretty at this stage. The bond market seems to believe them. Inflation expectations are not getting out of hand. The stock market is holding up, and the economy, although it's lost a bit of momentum, the recovery's lost a bit of momentum, it's still going. So I think it's steady as you go from the Fed tomorrow.
Neil, good to catch up. Neil Shearing, Capital Economics Chief Economist, the Group Chief Economist, on the data we've just seen in the last 15 minutes. Here's the price action for you on the S&P 500. Slight decline, negative coming into Tuesday morning on a 5-day winning streak and a record high on the S&P. We're negative 0.2%. Yields are in 4 basis points, 124.44 on a US 10-year. Euro dollar positive, about 0.1%. Euro dollar 118.14. That's a slightly stronger euro. Crude negative 0.2% to $71 and about 76 cents. The conversation on an equity market at record highs continues at the top of the hour. I'll be catching up with Jonathan Golub at Credit Suisse, the chief US equity strategist and one of the biggest bulls on the street, Tom, looking for 4,600. And let's be clear, at 44.22 on a close yesterday, we're not too far away.
Folks, you're really going to want to stay to see that conversation, because this is a nuance. It's not just about coming out with a number like 4,400 or whatever, and somebody, John's going to be out at 5,000, and everybody in the media is going to lather up. Guess what? It's about the nuance of it, and Golub writes a sector-based, exceptionally acute note about the nuances of what to do, and John, at the same time, is a bull, what not to do.
Where do you want to be beneath the index level?
Yeah.
That's the conversation for later. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro with your equity market just a little bit softer this Tuesday morning, pulling back from all-time highs perhaps on a 5-day winning streak on the S&P 500. Equity futures slightly negative. From New York City, heard on radio, seen on TV, this is Bloomberg.
With the First Word News, I'm Laura Wright. While federal health officials reportedly are close to announcing whether there will be new guidance on wearing masks. According to CNN, a decision could come today. 2 months ago, the CDC said most people who are vaccinated could go without masks indoors. That could change because of the highly contagious Delta variant. On Capitol Hill, those talks to come up with a bipartisan infrastructure spending bill have run into a number of obstacles. Senate negotiators ended the day still because of the surging prices for plastics. Demand for products such as packaging and materials for flooring held up during the pandemic. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Went up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
So on September 13th, which is the first full day of school, every single city employee will be expected to be either vaccinated or be tested weekly. This means everybody.
We welcome all of you on radio and television worldwide. The mayor of New York City, Bill de Blasio, of course, his term migrating to an end here in early 2022. There on the story of the moment in a widely vaccinated, widely healthy New York City. The rest of the nation, a different story. Joining us, Anne-Marie Horton out of Washington, our Washington correspondent. Lisa Abramowitz with me as well. Anne-Marie, John Farrell mentions a CNN headline of what could happen today. Who's driving the bus at the Biden administration? Who are you focused on this morning?
Well, it's definitely the COVID task force, Tom, when it comes to who's driving the bus. The Biden administration has continuously said that they would look to the scientists as well as the CDC, of course, and of course, Dr. Anthony Fauci on whether or not to move some of these mandates. Now, we have known for a while that they were discussing potentially to bring back mask mandates. This would likely to be in the federal government system and then encouraged across the nation. And this is because of the rise in the Delta variant. What I think is even more interesting is the memorandum that came out of the Department of Justice. That memo was supposed to be out July 6th. It came out on July 6th, but they made it public now because they want to let people know and private employers know and states know that it could be legal as they view. It doesn't mean it'll uphold in court, but there is also a debate about whether or not they're going to make vaccinations mandatory.
Very good. Amber, you got to leave it there now. Coming to us, Mr. Brady of Texas, Kevin Brady, of course, a Republican from Texas, and far more than that, I should say, one of the clearest thinkers on the Republican side on what is correct away from the federalism of this nation. Kevin Brady, I want to take you down to your Woodlands, down to Houston Methodist Hospital, and Kelty Baker, the head of medicine at that wonderful institution. I want you to explain how you dovetail Dr. Baker's science with the tone here, not of anti-science, but the tone of doubt that we see nationwide among the unvaccinated.
You know, I know this is frustrating. I am vaccinated, have been urging my constituents and neighbors to do the same. It is a difficult argument to win, frankly, with those who are unvaccinated. I think at the end of the day, it comes down to genuinely, for most, you know, they don't know that this is safe yet. Right. I think many of them are telling me, you know, get out of the emergency authorization, make that a permanent safety decision. I think that will help some, if not all.
Congressman Brady, you had great support for Donald Trump. He got vaccinated quietly without fanfare. What do you need from your guy right now to change the trend of the unvaccinated?
Yeah, I think the key thing here, obviously, reward people for being vaccinated. We're seeing in places like Houston where they're actually asking the vaccinated to mask up to protect the unvaccinated. I think that's probably the wrong incentive. Secondly, I think we need a permanent authorization for those vaccines and a lot more consumer education, certainly in our area. I think that would be key. So we're seeing, you know, more of this Delta in some of the variant. We're also unfortunately seeing that coming across the southern border, which is troubling people in a big way as well. So I'm hopeful we can keep making progress, but I'll tell you too, I think President Biden and Vice President Harris did the country disservice during the campaign, essentially planting the seeds of doubt on the vaccines developed under President Trump. And I think that
I'll give you that. Okay, Congressman Brady, please. I'm going to give you that idea that they planted the seeds of doubt, and it was part of the campaign as well. But you didn't answer my question. What does this nation need from the former president right now to explain to the Jacksonian unvaccinated that they need to be vaccinated?
Well, I think President Trump has been clear about this. He has talked about the need to be vaccinated. He's talked about the remarkable success in bringing these vaccines to market in record time. So I will tell you, I think it is this president and vice president who bear the burden right now. And I'll tell you, I'm willing to help and eager to help. I've been preaching this back home in a big way, especially as we see these new variants coming forward.
Representative, there is a huge delta, and forgive me for the pun, between Republicans and Democrats when it comes to the vaccination rates. And actually, in more heavily Democratic areas, the vaccination rates tend to be much higher, and people tend to be more open to getting vaccinated. How is it that you see President Biden playing a big role in shoring up confidence in vaccines if it's largely the Republican regions that still show doubt?
Well, I'll tell you, it was early on, it was the Democratic regions where the problems were at, and everyone criticized President Trump for that. I think, frankly, to be fair, this president now, and the administration bears the responsibility, and certainly, perhaps for the first time, bring both parties together on this mission, because I think it is so important. Right now, again, it's frustrating for those of us who think we should find common ground here to have this just go it alone mentality. I'm a little frustrated with it, but we have to keep making progress, and it's not going door to door, not mandating. I think we can do more of that. I think we can do better.
All right, in just 45 seconds left, Congressman, I'm wondering, you talk about bipartisanship and bringing people together in Washington. What's your chance, in your opinion, based on your Republican colleagues, of having a bipartisan agreement in the very near term on this $1 trillion infrastructure spending package that so many people seem to support, whatever side of the aisle that they are on?
Yeah, I think we're all hopeful that they can find common ground here. We haven't seen much of the details, but I think we're encouraging people to find common ground. I'm less optimistic about the votes for it, because clearly the Speaker, Pelosi, and Leader Schumer want this to be the pilot chute that pulls along that $3.5 trillion massive expansion of the welfare state. There won't be Republican support for that. If they were truly separated, if one went forward, period, I think there'd be strong support for infrastructure. We ought to get it done.
Kevin, thank you so much. Kevin Brady with us of Texas. Greatly appreciate it. The congressman from the Woodlands as well. Lisa, I want to pull back to the markets here with the Fed meeting tomorrow, earnings this afternoon from the others. And, I look at the market, and I'm sorry, there's a resilience to it. There's a bid underneath stocks.
And the issue to me is that we are seeing very strong earnings. I'm not going to knock the strength that we're seeing both in the bottom line of a lot of these companies as well as in the overall economy. The question is just, where are we in the cycle? How much more room do we have to continue accelerating, and what's currently being priced in? And I do wonder, especially given where real yields are, what could make the bid into stocks change, really? I mean, look at that negative real yield.
It's a very important point. When does the bid change? And what we know from history is when it changes suddenly. But to me, and again, we heard this from a number of guests, it goes back to what the Fed does. Marty Zweig, don't fight the Fed. Are we going to have a fight are we going to have a Fed that fights today, Lisa? I don't think so.
Are you going to be buying the next iPhone in the near future? That's what we're going to be talking about tomorrow.
Well, yeah, exactly. I mean, you know the answer to that. Wise.
How many?
How many? I have to buy I'm mandated for school to buy a laptop for Apple Thought.
Really? An Apple mandated laptop?
It's like one that Jeff Bezos took up into space. I don't. Stay with us through the day. Important a day on economics, finance, investment on radio and on television. Stay with us. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Wednesday, the Fed decides. How worried are they about inflation? What will they signal about tapering? Coverage begins at 1:30 p.m. Eastern on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from New York City for our audience worldwide. Good morning, good morning. Record highs into Tuesday morning. 30 minutes away from the opening bow. Your countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
From New York City, we begin with the big issue. China fears souring risk sentiment.
We really have a cloud of uncertainty.
The uncertainty is high.
More uncertainty.
Investors are surprised. The companies that have been targeted.
Clearly, this is beyond just the purest tech companies.
There might be another story right around the corner.
The Chinese want to have this regulatory crackdown across a number of sectors.
This is the very difficult point right now.
Classic battle between earnings delivery.
This authoritarian systems being a bit more aggressive.
You're seeing a reminder of some of the regulatory issues.
And for foreign investors, it can be difficult. Pretty high levels of foreign ownership.
Yeah, sure, you're going to get contagion.
And the question is really, how long does it last?
Investors are just waiting for this to shake out a bit.
This has really to do with domestic issues.
But we don't know how this is going to play out.
It's a complicated picture.
It's a complicated picture. For more on the markets, let's bring in Bloomberg's Abigail Doolittle. Morning, Abby.
Good morning, John. And big selling in China, not just tech shares, as some of those experts guests were mentioning, but overall China shares have been down in a big way. And it really started last fall when there was a crackdown on Alibaba's Jack Ma and then a halting of the Ant IPO. It extended into this year. That equals a bear market for some of the China equity indexes. And it more recently, Didi coming under a clampdown. And then over the last 2 weeks, private education being, for-profit education being turned into non-for-profit, more than $1 trillion of revenue there. And the pressure absolutely continues. You can see that the China tech share is really losing in a big way, from Tencent to JD.com, NetEase, Baidu. The biggest question for U.S. investors, John, though, may be whether or not the fear spreads. Is there contagion risk? Not from a regulatory standpoint, the regulatory crackdown that we've seen out of Beijing. That's not going to happen to U.S. companies, but just the fear. There is a spread of 50% performance between the NASDAQ 100 and a China index. Typically, when you have the world's two largest economies, you're going to have the indexes trading a little bit closer. What way will this go? It's hard to know. But right now, that divergence between U.S. equities and China equities really weighs. And in particular, the stocks all year sensitive to China trading in a range. Maybe this is why, John.
Abby, thank you. It persists. You wake up this morning, you look at the price action. We're down more than 4% on the Hang Seng, on the CSI 300, down by 3.5%. Over the last 3 days, the CSI 300 is down almost 8 percentage points. And you wonder, what does it mean for me? What does it mean for the U.S. session? Right now, equity futures, negative 7-8 points. We're down not even 0.2%. Joining us now to discuss, I'm pleased to say, is Jonathan Gollop of Credit Suisse and George Conclavos back with us of MUFG. George, it's great to catch up with you, sir. So let's go straight to you, George. I want to understand if there is a transmission mechanism for this pain in China to bleed through risk assets. Can you think of one?
Look, I do think that there is obviously interconnected markets globally, and that is, and plus the economies as well. So if there is any sort of financial conditions tightening throughout the Asia region, and if that starts to impact overall global growth, I think that's the transmission mechanism. I mean, Jonathan, I'm sure will go into, many U.S. companies have international earnings, and that plays a big part. But I think direct connection right now, probably too early to say. I think that plus a combination of the Delta variant, impacting global growth more, could then eventually leak back to the U.S. markets.
That's the important distinction here. You have regulatory risk and you have growth risk. And the question we're asking is whether the regulatory risk translates into growth risk and therefore bleeds out much more broadly than what we've seen so far. Jonathan, from your standpoint, your perspective, it reminds me of the summer of 2015 when we burst that bubble over in China and we woke up here in America, in London, trying to work out what it would mean for European, for US equity markets, and it took a while to bleed through. Is this one very different for you?
Yeah, first of all, I spend my time looking at U.S. markets, but I don't think so. To the extent, first of all, we're in earnings season. The numbers are coming in great. If there's some story out of China that would concern me, is that there's an economic problem or there's something related to the overall backdrop. But to the extent that there's individual regulatory issues, to me, the most important thing in the U.S. is, do we get some kind of a deal out of Washington? What happens to U.S. taxes? That's what's going to is going to move our market, not whether or not the Chinese government is re-engaging the market on certain specific kinds of companies.
And to your point, John, the earnings so far this morning, if we take a quick look at them, pretty decent. GE, 3M. After the close later, we'll hear from the likes of Microsoft, Apple, Alphabet. Those three alone, a third of the NASDAQ 100. Weighing in on the earnings, here's JP Morgan's John Bilton. Take a listen.
I think that this is a localized issue today. It's certainly causing some, around the globe to question some of their exposures, but by and large, it's not getting in the way of what is an absolutely thumping earnings season.
A thumping earnings season. With us for more, it's Bloomberg's Kaylee Lyons. Hey, Kaylee.
Thumping, solid, just good, John. Whatever you want to call it, companies are surprising to the upside. Just under 30% of the S&P 500 has reported so far. And on average, they are surprising to the upside by more than 18%. Profits more than doubling, up around 110%, but of course that's in part due to easy comparisons from the second quarter last year. Sales growth not quite as remarkable, up about 19%, still beating to the upside, and companies are actually getting rewarded for exceeding expectations. The average one-day price move after earnings is a gain of about 0.6%. Plus, as we see there, John, the breadth of the beats is noteworthy. More than 80% of companies are posting upside surprises on both the top and bottom line, and it's worth pointing out the share of companies beating on EPS has generally been increasing over the last decade or so. So either that signals companies are just getting better at lowering the bar for themselves, or it's just getting harder for analysts to estimate. And of course, John, the season isn't over yet. We still have a very busy week ahead of us. About half the market cap of the S&P 500 will report over the course of the week, and $9 trillion of that comes today alone. And just three companies, Apple, Alphabet, and Microsoft, represent about $6.5 trillion of that. That trifecta will report after the bell. Then, of course, Facebook tomorrow afternoon, Amazon on Thursday, those two representing about 28% of the weight that will report between Wednesday and Friday, John.
What a lineup for earnings. Kaylee Lyons, thank you very much. A lot of this dependent on the outlook. We talked about Goldman Sachs and their call yesterday. Just a reminder, here's the quote from Goldman. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. They downgraded their forecasts. JP Morgan and the equity team, led by Marko Kolanovic, sticking with it. This was their quote. The UK case is significantly down over the week. The peak appears to be behind us. This could be a signal to rotate back into reopening themes and give investors confidence that Delta is not a serious threat to global growth. So, John, I want to bring you back into the conversation. You're overweight discretionary, industrials, materials, energy, financials. Is there reason to stick with the JP Morgan view of the world? Are you with them on that over at Credit Suisse, John?
Yeah, but I'm not sure that the most important story here is the Delta variant. There was a point that was made a moment ago when we were talking about the earnings that the revenues are good, but the overall bottom line was much better. That's because companies, the margins are going through the roof. Their ability to not only manage expenses, but pass on these higher costs is absolutely brilliant. They're adding capacity, but not so much that they're squashing profits. And that's the big story. As far as what we saw this today with the industrial production, durable goods data that came out. It's a little bit slower on the industrial side because we're not able to manufacture the things that we want to manufacture. So I agree with one of the comments that you just made. This is going to be a longer process of reopening. It's going to get dragged out longer. And that's probably very good for corporate profits and for the stock market.
We can talk about the bond market as well in just a moment with a lot more detail. George, I want to bring you into the conversation on that. This appetite for cyclicals in the equity market, for some people, for that to work out, we need 10-year yields to be higher than where they are right now. Where they are right now is 124 on 10s, George. I keep asking the same question. You and I haven't caught up for quite a while, so let me ask that question of you. What are we doing down here?
Look, I mean, I think many have tried to explain away what's really been a massively technical market. And also, I think we've gotten, a little bit on the forecasting side, a little bit on the more lazy side to kind of extrapolate that, when you have a great outlook on the economy, therefore it requires a higher interest rate path. On average, that's true, but there will be moments like we went through in this past quarter, now going on 4 months of a pretty decent rally, where we could take a non-linear path to potentially lower rates first, which was my view, really of the last couple of months. That there was, just a lot of euphoria, and there was just the rate of change that was happening in rates was not sustainable. It would actually start to hurt the recovery at some point if it kept going to like 225, and then we're going to have a pause. I believe we went well beyond where we should be. I mean, 125 or even close to 1/8 is probably a little bit on the more extreme side and more pessimistic on the outlook. But it wasn't really just reflecting growth; it was reflecting these nonlinear type things that happen. Regulation and demand, and just there's technical features in the bond market which is very different than before.
And massively so. If you take real yields, I mean, look at TIPS. I talked about this earlier this morning, George. The TIPS market, the Fed holds a quarter of it. It's up from 10% a couple of years ago. How can you get a real read on real yields when the Fed has such a massive moment, a massive presence in this market?
That's 100% right. I mean, if you look at real rates. If you look at real rates from longer periods, although we didn't have TIPS markets before the mid 90s, if you go back, just kind of trying to forecast what TIPS would have been like in the 30s and 40s, we can get more negative real rates. So we're not really at the point where super financial repression has kicked in. I don't think the Fed wants to go there, but they always have that in the back of their pocket, and that's what's been helping overall risk assets, right?
John, this is the issue, I think, for anyone in the equity market, and I imagine it frustrates you. When you hear people talk about the bond market and the significance, the importance of it for the equity market, and then someone like George runs you through the technical factors, does it mean anything from where you're sitting? Should it mean anything?
Well, first of all, whenever I hear somebody saying it's for technical factor reasons, what that really means is we're throwing our hands up in the air because we just can't explain it.
I'll let George come back on that in a moment, John. Go on.
Flows, sentiment of positioning, all these things that we don't know. I think what the market is telling us is that we have this huge disruption going on right now that's creating a huge amount of inflation and delays in delivery. But once we get through this, and it may take a year or 15 months, it's going to take a long time. But once it does, we don't have an inflation issue. That ultimately the Fed's read that this is transitory is just right. That in 2 years, 3 years, 4 years, whenever we're through with all of this disruption coming out of the pandemic, that we're going to have a slower growing, lower inflation economy. And that's what we are. We had a sub 2% 10-year going into the pandemic, and we'll have a sub 2% inflation environment when we come out of or interest rate environment when we come out of the pandemic. And the market, the stock market does follow along. What we're focused on earnings, but the overall market is focused on, number one, is credit spreads, the ability of people to pay their loans, and the general health of the economy, and that's really strong, and that's why the market's going up. And the internals within the market, whether it's one sector or another, are being dictated. Growth and value is really being dictated by the direction of the 10-year bond yield. So it does matter for the tone of the market, but the story, I think, is clearer than we want to make it be.
John, since you threw a little bit of shade at a whole universe of bond market strategists, I want to give George the final word, if that's okay. George, the final word, sir.
No, listen, here's the thing. We threw out the textbook a long time ago. You can probably say go back to 2008, and fundamentals really have been playing a lesser role in bond markets. It's definitely been regulation. It's been central bank buying. It's been technical factors in the very short run. But yes, I mean, the bond market is also forward looking, and it's saying, and I generally agree with what Jonathan's saying, that we're going to be heading back to a more trend-like growth and trend-like inflation, and back to targets where the Fed's going to be comfortable with. But if you had told anybody we're going to have these sort of inflation prints and the bond market's rallying, they would think you're crazy. And so therefore, I mean, I think that's really where we're at, is that it bothered people that much that we're rallying in the face of higher inflation.
I agree. You could get the data call right and get the market call wrong. That's been the issue now for the last couple of years. George, good to catch up, sir. Great to have you with us. You're going to stick with us. George Concalves there alongside Jonathan Golub. Your equity market's negative 0.2% on the S&P. With your movers at the market desk, here's Abby.
John, it's a big earnings week, so let's get at it. And first, Tesla shares are up slightly. This after the company put up a very solid second quarter, their first billion-dollar quarter ever, executing well in the second quarter. However, analysts a little bit concerned about guidance, so shares higher, but not in a huge way. As for some industrial movers, let's take a look at GE, popping sharply higher. They put up a better adjusted earnings than expected. They boosted the free cash flow forecast on aviation strength. Waste management beat and boosted. 3M had been higher earlier because they also beat and raised. We'll be looking into what's dragging on shares. But the big laggard on the day, as you can see, UPS down 6.6%. They beat, however, their margin view for the year less than expected on an operating basis, so investors punishing those shares. And then finally, banks trading lower as we have a bid for bonds, yields weighing on banks once again, John.
Abby, thank you. Coming up, the Fed kicking off its two-day policy meeting. So before you hear from Chairman Powell, you need to hear from Michael McKee. We'll do that next from New York. This is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We have to differentiate between the near term and the long term. The Delta variant is here right now, and that's what's impacting the growth outlook for the rest of this summer and what's likely to impact the Fed's tapering decision and the logistics around that.
The Delta variant adding some uncertainty to the Fed's two-day policy meeting. Mohamed Al-Arian continuing to sound the alarm, writing the following. The longer the Fed puts off its tapering decision, the greater the chance of future financial instability and unfavorable spillover into the broader economy. Let's bring in Bloomberg's Michael McKee for more. Morning, Mike.
Morning, John. Well, what a difference 6 weeks or so makes, because you go back to June, the Fed meeting then, this is what they said about the Delta variant at the time. Progress on vaccinations has reduced the spread of COVID-19 in the United States. And then they noted in terms of inflation, it's risen, but largely reflecting transitory factors, sounding kind of sanguine. Now let's take a look at where we are. You look at the prevalence of COVID, and it is rising. It has started going back up again. And inflation has remained higher, as a matter of fact, gone even higher than it was in June. And so the Fed has a dilemma. What do? Do they acknowledge what's going on? Do they change what they're thinking because of what's going on? That's going to be the question. The consensus generally is that they won't. There obviously is not going to be any change in rates or rates guidance, and there'll be more talk about tapering, but no guidance on that. The question is, do they acknowledge inflation, and do they add downside risk from COVID? Right now, the markets are buying their arguments, so there doesn't seem to be a lot of pressure on the Fed to get through this. You look at the 5-year tips subtracted from 10-year tips, and you can see that over the time period of the last 10, 20 years, this is one of the few times that has been negative, that shows that the market thinks that inflation over the longer run is going to be lower than inflation over the higher run.
That's the T word somewhere in there.
Transitory somewhere.
You said it, Mike. Not me. Mike McKee, thank you, sir. Back with us, Jonathan Golub, George Concalves. George, let's start there. There's a recruiting mission taking place, and Fed President Jim Bullard's leading the effort. How tough will his recruiting effort be through the next 24 hours to get some people to come with him?
Look, I think that, personally speaking, just kind of as our house view, we do think the tapering has to start. I mean, the postponing it when we have, markets at the highs, and we have, again, bond yields have rallied over 50 basis points. If there isn't a moment in time where the Fed can actually taper, now's the time, right? So if they were to pass on this opportunity or not start the process at this meeting, would make no sense. And so although, it's a recruiting effort, and there's, the Hawks are trying to get things, I think by and large, I think the overall committee is on the same page that they have to start tapering. And I think it's just a matter of, the details that were going to be worked out over the next 3 months, really.
George, I've got no idea if dialing back MBS purchases will make a difference to what's happening in this housing market right now, but the housing data that came out at the top of the hour was phenomenal. House prices in America surging the most in 30 years, more than 30 years again. We've seen these numbers repeatedly. Do you think if they do pull back, George, they have to lean a little bit more heavily in the direction of MBS purchases and maybe away from treasuries?
This is why I feel like this is a much more difficult decision. Partly because, we're still in the middle of the pandemic. We're still seeing massive fiscal deficits and a need for stimulus over a longer period of time. And the Fed's trying to calibrate what that's going to do to the economy. But also, they've been buying a lot of bonds. Let's just not, kid ourselves that that's been helping out in keeping term premium low, too. And so if, the Fed were to decide, if they want to decide, look, we have a token gesture is to kind of meet the markets halfway and stop, buying mortgages first before treasuries. That's a harder message to deliver. That's why a lot of economists are on the fence about that. And as a forecaster, I'm also kind of 50-50. But if I were them, I would start tapering mortgages first and then move towards treasury, because you need to really have the Fed buying treasuries for much longer.
John, you're a data guy, a market historian. You don't just call the market forwards, you call the market from where we have been and what we've learned. And I do wonder from your perspective what we are learning about tapering and whether that's an environment where actually a market can still perform pretty well.
Well, first, John, we don't really have much experience with what the market does around tapers, because it was only the last cycle as an example. But if we look at outright Fed increases over the last 8 or 10 cycles, what you see is that the year going into it, the market does fine. And the reason is because the Fed raises rates in an economy that's strong and can handle it. And then if you look at what happens for the 2 or 3 years after the Fed has begun raising rates, it still does fine because we're early in the cycle. The real damage happens when the Fed has raised so much that they flatten the yield curve out. Now, I think one of the challenges the Fed is facing is that with a 10-year at about 1.25, how much room do they have? Forget about the taper. When they actually start raising rates, how much room do they have if they don't want to flatten the curve out? So I just think that with rates this low, they shouldn't feel like there's any rush to do anything.
The curve's flatter again this morning. We're down 5 basis points on 10s, a break of 124. Gents, it's good to catch up. To you, John, as always, Jonathan Golub of Credit Suisse, the biggest bull on the street, looking for 4,600, alongside a good friend of this program over the years, George Concalves. George, great to have you back in a seat, and good to see you again, buddy. Thank you. Coming up, the morning calls, and later, Wall Street's biggest companies reporting results this week. Apple, Microsoft, Alphabet, kicking it off after the closing bell. That conversation ahead with Invesco's Brian Levitt and Nadia Lovell of UBS.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
5 minutes away from the opening bell in New York City this Tuesday morning. Good morning. 5-day winning streak into Tuesday. We pulled back just a little bit, down 0.2%, down 1/4% on the S&P 500. On the Russell, down 0.6. The Nasdaq was in positive territory just briefly, pulling back from all-time highs. We're down about 0.1%. That's the price action. Here are the morning calls. We kick things off first of all with Argus downgrading AT&T to a hold. The analyst warning that the company could cut its dividend in order to shed some assets it's acquired over the past few years. That stock is negative 0.6%. Susquehanna upgrading American Airlines to neutral, $20 price target. The analyst seeing accommodative credit markets and little disruption from the Delta variant. And finally, Baird raising its Tesla price target up to $764 after results. The analyst highlighting the automaker's continued revenue growth and margin improvement. That stock is positive, a little more than 1%. Up next, Wall Street's biggest companies reporting results this week. That conversation with Invesco's Brian Levitt and Nadia Lovell of UBS. From New York, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's get the week started in a much more bigger way, more profound way, with the earnings coming after the closing bell this morning. Good morning, later this afternoon rather. Equity futures are negative by 10 points on the S&P 500, down by 0.2%. On the Nasdaq, where are we? Negative 13. We're negative almost 0.1% there. The other performance on the Russell, the small caps, down 0.5%. That was the opening bell. Switch up the board and get to the bond market. Your 10-year yield looks like this. A yield on a 10-year, 123.78. Yields lower by 5 basis points. The lows of the session going into the opening bell in the equity market, on the bond market. Outside of that, in foreign exchange, euro-dollar 118.22, positive about 0.1% and change. A stronger euro, a weaker dollar. Crude unchanged at 71.87. Looking ahead to a big afternoon after the close, we get 3 big tech titans. Before we get there, here are your movers at the market desk. Here's Abby.
Yeah, John, big tech earnings after the market, after the bell. But this morning, lots of big industrial names, including GE and Raytheon. But we also have Tesla reporting yesterday, and that stock now up about 0.5%. So not a huge gain, a very strong second quarter, but investors, and analysts a little bit worried about guidance, a little bit vague. So just a relatively modest gain. This stock tends to move in a huge way after earnings, not as much today. But GE being rewarded for a free cash flow view that has been boosted on strong aviation, and Raytheon, they have also put up a beat and boost quarter. They are seeing, though, interesting, less pent-up demand for aviation parts. Nonetheless, you see both GE and Raytheon climbing higher. Where we have some pain, though, interestingly, the crypto space. Blockchain is rallying once again, but after their 20% up days, Riot Blockchain and Marathon cooling off. We also have the big banks lower. This, of course, as bonds are bid, yields down, weighing on banks. And then finally, rounding it out, China tech shares down once again, a big bear market for China tech shares as Beijing cracks down, that regulatory crackdown, weighing, not spreading here to the U.S., but clearly taking a chunk out of those China tech shares, John.
Abby, thank you. That's been the story globally over the last several weeks. Abby, thank you. The S&P 500 negative about 1/3%. 5-day winning streak into Tuesday. We snap that. We break lower just a little bit. Bottom of the pile is energy down by 1.9%. Consumer staples, top of the pile on a relative basis, still negative, still down by about 0.1%. After the close, it is all about big tech. A combined $9 trillion set to report today. For more, here's Bloomberg's Kaylee Lyons.
Hey, John, and as of that $9 trillion, $6.5 trillion is just the 3 large cap tech companies, Apple, Alphabet, and Microsoft. A lot of weight getting set to report after the closing bell. And of course, that will be followed by Facebook tomorrow and then Amazon coming up on Thursday. And we could see some big moves off the back of these results. Facebook right now is priced as the most volatile earnings mover with an implied one-day move of 7.3%. For Amazon, Alphabet, and Apple, a move of 4% plus is priced in about 3.5% for Microsoft. And again, John, these are mega cap companies, so they have the power to move the broader market. And looking at history, that might not be a good thing. I'm going to give a shout out to our colleague Dave Wilson for his chart of the day, because he pulled this over from Cornerstone Macro. Carter Worth heads up technical analysis over there, and he found that in past cases, when all big 5 of the S&P 500 tech companies have reported quarterly results in the same week, the broader index has finished the week either lower or little change. There's been 5 instances of that since 2015, and the S&P 500 has fallen about 2.4% on average on the week, John.
Is that an observation masquerading as analysis? That would be what Cameron Christ would say about something like that.
Call it what
Kaylee,
you want.
thank you. I don't know what to do with that. Kaylee, nice, thank you. I guess it's useful for someone. Esty Dweck of Natixis still looking for opportunities in big tech. Here's what she had to say.
don't dismiss tech. You see the earnings, you see the growth and the sustainability of those earnings. So it continue to have some of those tech names and some of those defensive in the portfolio. As growth slows a little bit, even if it remains at high levels, those are going to be sectors we want. So I think a barbell approach makes sense, and a buy the dip approach continues to make sense as well.
Joining us now, Invesco's Brian Levitt and Nadia Lovell of UBS. Nadia, I'd love to come to you first. Big tech reporting after the close. Is that an area of the market that you still have confidence in?
You know, we're actually neutral on tech. I think that tech earnings will be fine. They tend to surprise on the upside. But we do think that there's better growth and rewards in the more cyclical areas of the market. You know, economic and earnings growth isn't scarce. And quite frankly, tech valuation is a bit stretched. And so we do think that tech could face some risk if interest rates start to rise. And that is our core view. We do think that rates will start to rise. But that said, I would say, you know, we are more in favor of the more cyclical areas of tech, particularly semiconductors, while there has been, of course, some concerns around peak growth, we continue. Yes.
You're still there, Nadia. Carry on.
We continue to believe that the supplies will remain tight well into 2022. I mean, quite frankly, like supply is about 30% below demand, and we think that it will take 3 or 4 quarters for supply to catch up with demand, and also about 1 or 2 quarters or so for that inventory to rebuild. And so we think that semis will be in this upward revision cycle, and that would be a positive.
Nadia, if there was someone speaking to you in your ear, it wasn't me. If there's a technical problem, I'll take the time now to try and work it out and cross over to Brian. Brian, I know that that's a pocket of the market that you do like, growth equities.
I do, and you know we've had this environment in the economy where we've gone from a quick recession to a quick recovery. We're expanding, but clearly the bond market is telling us that there's a slowdown. And of course, as the bond market has been telling us, there's a slowdown. Growth stocks have outperformed. Now, that doesn't mean that this is an economy that doesn't pick up a little bit more momentum. Hopefully, as we move through the Delta variant, maybe we can see another expansion, a pickup in this economy. But the reality is, I think we're going to moderate to a more sustained level of growth over time, similar to what we saw from the middle of 2011 through the end of 2019. And in that environment, value stocks didn't do terribly, but growth stocks did outperformed. And that's because investors are looking for structurally advantaged businesses that can grow in what's, in my opinion, going to be continue to be a slow growth world.
That's the question. And the question for you as well, Nadia, if we do get that deceleration in the way that pretty much everyone anticipates and assumes will happen pretty quickly from here, why would you want to be long what you are long, consumer discretionary, energy, financials, industrials, in that kind of world, Nadia? Can you explain that to us?
Yeah, I think what you're seeing, and you're seeing this throughout the earnings season, the reality is that consensus continues to underestimate the economic recovery and how that translates to earnings growth, particularly for those cyclical sectors. And so we think that consensus will have to catch up with that, and we will see an earnings upgrade cycle for more of these cyclical sectors, and that will be a positive. We also do think, obviously, like the more value-oriented sectors have performed more recently due to rates coming down, but we think that will reverse course as we enter the second half of the year and into year end, and we look for the 10-year to sort of move back upward towards a 2% by year end, and that will be a positive for these sectors, particularly financials. 2%
is a big call, Nadia. Walk me through that. What gets us to 2% from the sub 125 we're at this morning?
Well, as we know, most of the recent pullback that we've seen in yields has to do with technical factors, obviously also some concerns around the Delta variant. We think a lot of those concerns will subside if you look at the UK as a case study. In fact, that you have seen cases spike in the UK over the last few weeks, but you've seen that sort of come down in the most recent week. And so we think that the US will follow the same course. It will not derail the economic growth nor the bull market. And we think that that will be a positive and also help to push rates back up.
Nadia, that's the JP Morgan view of the world as well. And I'll bring you the quote. We mentioned it a little bit earlier in the program. Marko Kolanovic and the team said the following: with UK cases significantly down over the week, the peak appears to be behind us. This could be a signal to rotate back into reopening themes and give investors confidence that Delta is not a serious threat to global growth. Brian Levitt, your reaction to that quote, your response?
Yeah, and I think, Jonathan, what you're talking about here is real tactical timing type moves in the portfolio. I think that that's right. I don't think that 122 or 123 on a 10-year is necessarily appropriate given where the economy is likely to go and what the rate of growth is going to be. So you could certainly say rates move up in the coming weeks if the Delta variant is less of an impact on the economy as we may fear right now. But the point is, to what end? I mean, if you were to tell me rates are going to start trending up towards 150 and you'll have another move higher in those reflation parts or the reopening parts of the market, I'd say, yeah, sure. What I'm trying to think about, though, is over a multi-year period. And the way I see it is we're still likely, nothing structural has changed. We're still in a world that is lacking growth. And so in a world that's lacking growth, you should not expect a sustained move higher in interest rates to significantly higher levels. You shouldn't expect a sustained move higher in economic activity. This is a reversion. We're trying to get back to some type of mean. And from there, again, my view is rates stay low for long and growth stocks are the persistent outperformers.
Brian Levitt, Nadia Lovell, bit of daylight between the two of you. We'll keep this conversation going. Let's head back to the market desk. Small decline on the S&P 500. With your movers, here's Abby.
John, yeah, a small decline for the S&P 500. And of course, ahead of the big earnings lineup that we have this evening after the bell for big tech, the likes of Apple, Microsoft, and Alphabet reporting more than $6 trillion worth of market cap, plus Starbucks. The bar is very high for big tech. Valuation is high since they've been climbing so much. And it's interesting to think back to the first quarter reported in April. They put up blowout quarters and still the stocks dropped. So let's see what's ahead. Starbucks is going to be an interesting tell on the state of the U.S. in particular around the reopening. Comps, same-store sales expected to be up 74% in the Americas. As for earnings that have happened, UPS down sharply on a margin view that's just not making the mark. They brought it down in a bit, 12.7% versus 14% for the operating margin. Plus fears if the pandemic is coming to an end, is that going to weigh on their business? You can see that theme weighing on FedEx. And then finally, taking it macro, all 11 S&P 500 groups are lowered. The last time I looked, yes, indeed, energy and financials among them. You can see ExxonMobil, Chevron down sharply, even with oil higher, and then the banks, the big banks down with the long end of the curve, those yields in weighing on banks. So the reflation trade not happening today, John.
Abby, thank you. Coming up on the program, the C-suite lining up behind a bipartisan infrastructure plan. More on that conversation next. From New York, this is Bloomberg.
Billionaires in space?
What defines going to space?
There is a level where you
Is
get...
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around, and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance. Weekdays on Bloomberg Television and Radio. Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Is Bloomberg.
I am fully committed to passing a bipartisan infrastructure bill. Senators should be on notice that the Senate may stay in session through the weekend in order to finish the bipartisan infrastructure bill. And as I've said before, further delays may mean that the Senate will remain in session into the previously scheduled August recess.
Talk stalling with Senate negotiations pushing past one more deadline. The latest setback stoking a response from more than 140 executives, writing in a letter the following: "We urge Congress to seize the moment and act quickly to pass this bipartisan initiative. It will leverage significant private investment and generate a strong return for the federal government." With us for more down in Washington, our Washington correspondent, Bloomberg's Anne-Marie Hordern. Morning, Anne-Marie.
Good morning, John. Deadlines come and go in Washington, D.C., as you can see here. We've been through this before, but the negotiations are continuing. And Senator Bob Portman, who's really the lead Republican on this bipartisan infrastructure agreement, was on the phone last night with White House aides, including Steve Ricchetti, to try to nail down and hammer out the final negotiations. So the direction of travel is positive in the sense that they are still negotiating, but there are hurdles, as you mentioned. There are setbacks, and some of this has to do with transit funding, some water funding for those new pipes, and potentially fresh and better water for parts of the country, as well as also any money left over from the COVID-19 response. Where would that be put to use? But what you heard there from Senator Schumer is that he's willing to work through the weekend, and also potentially those senators will have to forego their holiday plans for August recess if there is no agreement shortly.
Anne-Marie, quickly before you run, another issue we've got to talk about, and you mentioned COVID-19. Earlier on this morning, CNN reporting, citing a source, that a federal decision on the mask mandate would be imminent. What are you hearing down in Washington? How active are those conversations? Do we have a decision?
Well, just yesterday, John, you heard Dr. Anthony Fauci tell CNN that he's been in these conversations and it's under active consideration. So there has been some discussions within Washington, D.C., whether or not there would be this mask mandate, which really would be a reverse from what we heard earlier from the CDC just a few weeks ago about how you don't need to wear a mask if you're vaccinated. This has been brought up in the White House, especially since we had seen some breakthrough cases. So we are waiting from this agency. It would likely come from the CDC. The Biden administration says they will look to the CDC for the science to guide us about if or not. We don't know what the mandate would be, but if a mask mandate would come back. And just quickly, John, there's also been talk about mandates potentially on vaccinations, which we see some state and private employers take on.
Saw some of that yesterday. Anne-Marie, thank you. Thank you very much. Down in Washington, D.C., our Washington correspondent. We've got two final things to do. Work our way through this infrastructure package and what it means for this market, but also the possibility of extra restrictions for this economy and what that would also mean for this market as well. Let's bring in Brian Levitt and Nadia Lovell for some final thoughts. Nadia, let's start there. If we did have something like a federal decision on a mask mandate later today that moved in the wrong direction, back to where we were, what would that mean for markets? From your perspective, what would you expect to happen?
You know, I don't think that it will be much for markets because at the end of the day, even if we do reintroduce these mask mandates, we don't see any potential for a lockdown, and that's more important. So economic growth should continue, the reopening should continue. I think more importantly, we aren't seeing any real change in consumer behavior. We're seeing consumers continue to go out. We're seeing an increase in air travel. We're seeing an increase in the use of public transportation. We're seeing an increase in bookings for hotels and as well as for restaurants. And that's what, at the end of the day, is important for the service sector and a recovery in the service sector.
Brian, does that resonate with you?
volatility in the markets. I mean, I don't think the markets would take it incredibly well. And so you're seeing today that the more cyclical, economically sensitive parts of the markets are not performing as well. And I would think that a mask mandate isn't going to change my view on where we are in the cycle. It's not going to lead me to think that we're heading towards a recession. But it could certainly cause some disruption to the markets in the near term. But I think what's critical in all of this is that it's almost paradoxical in that this could actually extend the cycle because, where was everybody just a few months ago? They were worried about excess, significant inflation, an economy overheating. Last February or March, we're talking about when the Fed interest rate hikes are coming. And I remember calming people then saying, not going to happen. And this would slow things down a bit, and that takes the Fed off the table for a while. And so if cycles end with Fed tightening, then again, paradoxically, I think this would actually extend the cycle.
Brian, the issue is, though, it might slow down a specific part of the economy, and that's the supply-side response that we need to see, which in the Fed's mind would keep them at zero rates for a whole lot longer. Brian, what would you say to that?
Well, right. I mean, it would slow down the demand side and potentially the supply side as well. And so, it's not just on the supply side. So all this demand that we're seeing right now, and a lot of what's driving the inflation are things like airline fares and hotels, and that's all part of the reopening. And so if you slow that a bit, you could see that start to come down, maybe core CPI come down a bit. But you're right, the supply chain issues are going to continue to be a challenge. Ultimately, the bond market's telling us we'll work our way through it. I suspect we'll work our way through it. Inflation's going to continue to be high for some period here, but ultimately we expect the supply side to be able to respond to it, and that's certainly what the Federal Reserve is expecting.
I've got no idea, Brian, what the bond market is telling me anymore. I'm pleased that you understand. 123 on a 10-year right now, down by 5 basis points on 30s, 189. Nadia, I'd love a final word from you. You recently upgraded your call on the S&P 500. Can you walk our audience through just the thinking behind that for you and the team? Nadia, just the thinking behind that, please. I lost my voice. Forgive me. Carry on.
Okay. Yes, we are continue to be bullish on the outlook for markets. Again, like I said earlier, we continue to think the consensus underestimated EPS growth. And so for this year, we're looking for EPS growth of about 43%. Next year, we're looking for, again, above trend growth. Obviously, that growth will moderate. We're looking for a 10% EPS growth. And that's including the potential for higher corporate tax rates. So if that's about a 4 or 5 percentage points drag from higher corporate tax rates. So if we don't get higher corporate tax rate, earnings growth should be exceptionally strong again in 2022. And that's what's caused us to upgrade our expectations for the market. We're looking for 4,500 by year end, and we're looking for 4,650 by June of 2022.
It's Tuesday morning, and I need a rest apparently already. You guys have been great. Nadia Lovell, Brian Levitt, thank you to you both. Thank you very much. Your equity market down 0.4% on the S&P with your sector price action. Here's our stocks editor, Dave Wilson.
Thanks, John. We're starting to see a smidge of green among the 11 main industry groups in the S&P 500. Communication services and real estate higher at this point, though they're both up less than 0.1%. And the point that Brian Levitt was making about the weakness among the economically sensitive areas of the market is really borne out by looking at these groups. Commodity producers, energy and materials with the biggest declines, industrial companies, the consumer discretionary category, where you find Tesla, which has actually turned lower after initially rising in response to its second quarter results. Now, as far as the industrial companies go, we've heard from 4 of the biggest ones today in terms of their quarterly figures, and the disappointments at UPS and 3M are outweighing more positive results from General Electric and Raytheon. And in fact, UPS is dragging down FedEx as well, which explains why the industrial group is one of the worst performers on the day. Now, you look at the S&P 500 Industrials Index, it peaked about 2.5 months ago, kind of stalled since then, and what's happening with the latest earnings reports isn't really going to help this group get back to its highs, John.
I think if slowing mask demand is an issue for a company, that's a good thing for the broader market. And let's hope it remains that way. I've got no idea if it will. Hey, Dave, good to catch up. Thank you. Coming up, the market moving events you need to be watching, your trading diary from New York. This is Bloomberg.
The technology landscape has gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
25 minutes into the session this Tuesday morning. Good morning. We were on a 5-day winning streak coming into Tuesday. Now we decline by 1/3%. On the S&P, on the Nasdaq, we're down about 0.5%. That's the price action. Let's get to the trading diary. The story shaping up as follows for the day and the week ahead. Consumer confidence numbers coming at the top of the hour. Then the earnings. Apple, Google, Microsoft, all reporting after the close. Then Facebook tomorrow and Amazon later in the week. On Wednesday, we get a fate red decision and Chairman Powell news conference. And finally, personal income and spending numbers to round out the week on Friday. From New York City, this was the countdown to the open. You can continue the conversation with me on Twitter at FerroTV. Thank you very much for choosing Bloomberg TV. This is Bloomberg.
Happening in the business world right now is how to get workers back to work and what benefits to give your employees. Microsoft is asking employees to be back in the office 51% of the time, but you're flexible about the rest of the time. Is that a permanent policy? And for those companies that are saying you have to be back in the office 100% of the time, are they on the wrong side of history?
I think we at Microsoft, we want to be much more data-driven. I also think that in time, if a year from now, we will have more sense of what the real structural change and needs and the expectations of both our employees and our customers are. And we'll really think about long-term policies based on, quite frankly, having all of that data behind us, because otherwise I think we are trying to come up and being too overly dogmatic when I think we need to be more experimental in our approach to return to work, because I do fundamentally believe the world's changed.
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. the most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet. So we need a refill of this medication. After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you'll use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning, who used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral Murder Video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan War Logs, 390,000 documents known as the Iraq War Logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails show Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for fifth generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second.